There's a lot of potential earnings upside ahead.
The health of the stock market's going to depend on earnings.
You do need to see earnings estimates continue to rise, we think, in order to support the market.
We're going to see solid but not blockbuster revenue growth in the third quarter.
Earnings need to do a lot more heavy lifting as we turn the corner into 25.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now on a two-day winning streak on the S&P 500, hitting the ground running to start the week, the 46th all-time high of the year. We're still counted on the S&P 500. Equity futures down by 0.1%. On the Nasdaq 100, we're down by a little more than that. The calendar for earnings looks a little something like this. Later on this hour, we'll hear from Bank of America. Then it's on to Goldman Sachs. Lisa, then it's on to Citi.
And real question here about whether you get the same kind of tone about the consumer remaining strong. I just want to point out, not only was it the 46th record high for the S&P 500 market weight, but it was the 22nd record high for the equal weight. This is a broad-based rally across the board, as it's not just big tech and Nvidia, but everyone realizing a no landing might be a good thing, and that's what people are seeing in the data.
Bank of America Global Fund Manager Survey just drops. Bull charge, the biggest jump in investor optimism since June 2020 on Fed cuts, China stimulus, and Lisa, a soft landing.
So how much of this is predicated on the idea of a Fed being really dovish and cutting rates significantly? Or is this basically all news is good news? Because essentially, if you have a no landing, it is a good thing. If you have a soft landing, it's a good thing. And you're not going to get a hard landing. Stop thinking about that, because basically the consumer is strong. That's basically been the tone, even as you've had this incredible bullish tilt, whether it's in the fund manager survey or whether it's just in positioning. What you have seen is a pricing out of as many rate cuts, and it hasn't seemed to matter to equity valuations.
And you get a helping hand in the commodity market this morning. WTI, Brent crude, negative by more than 5%. AMH, welcome back around the table. The Washington Post reporting overnight that maybe those energy assets in Iran might be spared.
Yes, so potentially the United States, Washington is getting through to Benjamin Netanyahu and what they deem as acceptable when it comes to retaliation. What you see in the commodity market is basically that risk premium that came from the President of the United States about a week and a half ago, when he was maybe a little bit too transparent with reporters, saying that these energy assets were in discussion that Israel could target. Now that risk premium is coming right out of the market. The big development, I think, was over the weekend, what Israel got maybe in return for this, and that was the THAAD missile defense system. There's only 7 that the United States has their hands on, and they're sending one to Israel.
Does it stop here, though? Let's say energy assets are spared this time around. We know that Iran's going to respond to this. They've said they already will. If they respond, won't Israel respond? What's the end to all of this?
Well, one is potentially a cycle of retaliation. The other is what happened when the Trump administration went after Qasem Soleimani, which is in closed-door negotiations through interlocers. What you had was the Iranians saying, we are going to retaliate, but it's going to be a retaliation in name. We are not going to really try to go after something substantially because we want this to end.
This is a long game, and I think that that's what you're getting at here. Halima Croft saying even if there is this relief rally or relief sell-off in response to maybe not having a strike immediately on the oil assets, don't think that the threat has completely subsided because of the cycle and because of how hard it is to de-escalate when you've got two enemies that are deeply entrenched against each other.
Breaker 70 on WTI 69.79. We're down by more than 5%. One piece of the market puzzle we've left out. Bring up the board. We've talked about equities. We've talked about commodities in the bond market. This relationship between fixed income and the commodity market, well established over the past few weeks, Bramo. We're down about 3-4 basis points on a 10-year.
This, to me, is fascinating. We saw a huge spike up in the 5-year break-even rates, the expectation for 5-year inflation. We saw in the University of Michigan survey a real pop-up in terms of the 1-year inflation expectations. All of that fades when oil prices come down, which is kind of amazing because everyone says it's not such a clear line from oil prices to actual inflation and to bond yields. It can be deflationary or even disinflationary. But at a certain point, you have to wonder if that's really been what has been the driving force behind the sell-off in bond yields.
Yield to lower across the curve, 2s out to 30s. Your 30-year yield down by almost 6 basis points. Coming up this hour, we'll catch up with Max Kettner of HSBC as the S&P 500 posts its 46th record high of the year. Bloomberg's Saleha Mohsin as Trump and Harris make their pitch to Pennsylvania, and Ken Leon of CFRA as big bank earnings resume on Wall Street. We begin this hour with stocks at all-time highs as earnings season ramps up. Max Kettner of HSBC still bullish. A powerful combination of dovish Fed, China stimulus, low near-term EPS expectations and subdued sentiment leaves us very bullish on risk assets. We find it incredibly tough to form a bearish narrative from here. Max Kettner joins us right now. Max, you've talked about why you're bullish. Let's talk about where you're bullish. High yield credit, overweight even with spreads this tight, Max. Why?
Yeah, good morning. I think, look, when you look at Euro high yield credit spreads, actually, they are still, pricing in a bit more premium than the US high yield counterparts. We did close the US high yield overweight that we had really for a long time earlier this month. Overall, however, I don't think, it's an environment where you want to be in risky credit over equities anymore. I think it's particularly, you want to be in equities in particular. Yes, you want to be a bit overweight in emerging market debt and high yield credit in particular, but this is the environment, this is the sort of environment that Lisa was just describing. That is the any news and all of the good news is, or all of the news is good news, and that is particularly favorable for equities and in particular for the US.
This is echoed in the fund manager survey from Bank of America this morning, Max. I went through the line a little bit earlier, but really it sounds like you wrote it. The biggest jump in investor optimism since June 2020 on Fed cuts, China stimulus and a soft landing. Max, the question you ask in your own research of yourself that you get asked all the time, what would it take to make you bearish? Is that question alone what makes you bullish?
Not alone, but definitely it's one of them. When we look, for example, at our sentiment and positioning indicators, the interesting thing is that actually the bearish and the bullish signals, so the buy and the sell signals, are still pretty much on balance, pretty much the same. So what we're seeing is that sentiment overall is still pretty neutral. So I think, at least when we speak to investors, sort of the overall backdrop is investors are pretty constructive, they're pretty positive, but I think overall there's still a bit of caution going into the election. Going into, you've got geopolitical uncertainty. You don't really know around the labor market. Fine, we had one good print around the labor market, but is it really out of the woods? So there's a few questions around the cracks in the labor market as well, around the strength in the US economy. And that keeps, investors in a really weird position where they keep telling us, yeah, we're kind of constructive, but at least, in the near term, a bit more cautious. And that is reflected in our sentiment and positioning indicators in the last couple of weeks. Throughout that, actually, we had them closer to a buy signal, despite equities at an all-time high, than closer to a sell signal. And that alone is really part of the reason why we're so constructive and so bullish.
Max, there was a time when no landing was thought to be negative for stocks, because essentially what that would mean would be inflation that didn't come down and bond yields that remained high. Why is that no longer a concern?
I think it will be a concern again when it's properly no landing, when we really start talking about, hey, can the Fed not cut at all anymore, or may they even have to reverse course, and may they even have to hike again? Let's remember that was the case what we had in 2022 when, all of a sudden in all of these episodes, there was way more rate hikes being priced in, and that was the time when credit spreads suffered, when equities suffered, where pretty much everything sold off. We had the same environment in September, October last year, again, where we had Jackson Hole saying it's higher for longer, we can't cut rates at all. We had the same environment in March, April this year, when the rates market was starting to price a possibility of rate hikes. Once that comes back, and once that is really properly coming back into the pricing, then it will become a problem for valuations across all the risky assets. But let's be honest, right now, we're so far away from that, right? We've gone from sort of 9, 10 cuts by the end of next year, we've gone to 6 cuts. So what? That's just a reflection of good growth, good earnings growth, good profitability, good GDP growth, and we'll take it, right? And only once really we're going to see sort of a 180-degree shift, the Fed not even saying pausing, but we're done. That would be a problem, I think, for risk assets.
So is that, just to put a bow under this, how much are you basically saying that if the Fed were to come out and say that they were only going to cut by 25 basis points this year and only had a few more before they might reach neutral, that could be a catalyst, or it really has to be something more definitive where you start to see inflation reaccelerate in a material way?
No, I think it would have to be something more definitive, and it would, to put it a bit more precise, I think it would have been, or it would need a really 180-degree shift from what Powell said during Jackson Hole. Remember, Jackson Hole 2 years ago was saying, he was saying there will be pain for households and businesses. That's what we need. That is what is required to bring inflation down. Last year in Jackson Hole, it was all about higher for longer. This year, it was all about we don't like more pain, we don't seek more pain, we don't welcome it, we'll act against it. So it's literally bringing in the Fed put again. And let's remember that's a way, way different level of rates compared to the 2010s. They've got an awful lot of room to cut. So if, say, for example, one of the next 2-3 payroll data actually do come below expectations, they have a lot of room to say, fine, now the next time we'll go 50 again, and that can cushion any downside for risk assets. So the Fed put now, I would argue, is much more credible even compared to the 2010s. So it would need a really, really dramatic, much more significant shift to become a problem and start becoming a problem for risk assets.
Max, when you look at the Bank of America Global Fund Manager survey released this morning, the 3 top tail risks are geopolitics, inflation, U.S. recession in that order. What do you rank as the biggest risk?
No, I think it is actually inflation. It is the rate side of things. I mean, overall, we've got to figure out what is the biggest one. Is it more towards recession or is it more towards inflation and rates? If you are of the view, like we've been for the last 2 years, that the US is not going to go into recession, that really the market is underestimating the strength of the US consumer, the strength of the underlying US economy, then by definition, your biggest risk has to be rates and, at some point, perhaps yields increasing by so much again, either the velocity or the level that it starts becoming a problem for valuations across the board again. The reason why I also think it's because it's the biggest risk, because if that really materializes, there is nowhere to hide. Remember in March, April this year or Q4 last year, everything sells off. It's equities, it's credit, it's emerging markets, it's rates, everything sells off. And the only place to hide is the dollar. So from a hedging and from an asset allocation perspective, it is by far, I think, the biggest risk.
So given how bullish you are you potentially in the no landing camp now?
I wouldn't call it no landing. So I think the market really always exaggerates a bit, right? You guys were talking about short-term inflation expectations. Let's remember, we started at sub 2% short-term inflation expectations at the start of the year. They went all the way up almost to 3%. We went down to 1.7. We're back up to almost 2.5. We're backing down a bit. So the market always goes from, oh my God, it's total no landing. No, it's total soft landing. It goes from one extreme to the other. I think the reality is that inflation, we had this inflation shock, we had disinflation, and now we're just not quite down to 2%, right? We're a bit stuck. That is actually not a problem. It's not a problem at all for earnings. It's actually good for earnings because it's a nominal figure. It's good for nominal growth, and that I wouldn't call it no landing. I think the market is getting a bit too obsessed around these definitions and always swings from one extreme to the other. I would say it just continues to be a really supportive environment for nominal growth, and that is an environment that is particularly supportive for equities.
Hey, Max, still bullish, and it's good to catch up. Max Kettner there of HSBC with your equity market at all-time highs. We talked about the FMS, the Fund Manager Survey, coming from B of A a few times. The biggest jump in global growth expectations since May 2020, driven by the US, driven by China. 76% of investors say soft landing. Lisa, only 8% say hard landing.
And what you have is people deploying cash. When you start talking about cash on the sidelines, the cash level fell from 4.2% in this survey to 3.9%. So they're acting on it. When people say that they're bearish or worried, take a look at what they're doing because it's very different. And I think that's what we keep hearing.
Just a little bit softer in the equity market this morning, down by not even 1/10%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Google has signed a historic agreement with startup Keros Power to invest in the development of nuclear energy, with ever-growing interest in powering AI data centers. 7 small nuclear reactors will be constructed in the U.S., from which Google will buy power. The companies are targeting a goal of 500 megawatts of nuclear power by the end of the decade. Hundreds of anti-Israel protesters gathered at the New York Stock Exchange just ahead of the opening bell on Monday morning. The group staged a sit-in on the streets just outside of the building entrance on Broad Street. Over 200 people were arrested, with several protesters handcuffing themselves to the building's doors. The event coming just over a week after Israel marked 1 year since the October 7th attacks. NASA has its set sight on Jupiter. The administration launched a $5.2 billion mission to the planet's frozen moon Europa to determine if it has conditions that could host life. After over a decade of preparations, the spacecraft lifted off aboard SpaceX's Falcon Heavy rocket in Florida on Monday. The vessel will come within 16 miles of Europa's surface and is scheduled to perform around 50 flybys over 4 years. And that's your brief. John.
Hey, Danny, thank you. You'll hear more from Danny in about 30 minutes' time. Up next on the programme, driving home the economic message.
Under my economic plan, we will bring down the cost of housing. We will lower the cost on everything from healthcare to groceries.
You've been eaten alive with inflation, and all I'm doing is getting you back to even. We're going to get your prices down.
That conversation up next, live from New York City this morning. Good morning. Two-day winning streak on the S&P 500, just a little bit softer this morning. We're down about 0.1%. The bond market reopens for business with a bid. Yields are lower by 3 or 4 basis points, just north of 4% on 10s. The standout move this morning, crude. Lisa, it's a break of 70. WTI down by more than 5%.
A report in the Washington Post that Bibi Netanyahu was conceding to requests from the United States, basically saying that they weren't going to go after oil assets or nuclear assets, but rather military assets. That said, so much remains to be seen. Also, you have, of course, the IEA coming out and saying demand is going down. We're not necessarily going to see that surge up. How much of this is noise and how much of this is reality?
So it feels like it's the Biden comments coming out of that risk. But to your point on what the IEA said and what we've seen over China, especially over the weekend when the Chinese finance ministry didn't really excite everyone about what is happening within domestically in China, it's that demand picture in China. Those fundamentals in the supply and demand picture, they're not changing, and they're negative for the price of oil.
It's a 5% move on crude this morning. More on that move a little bit later this hour. Under surveillance this morning, driving home the economic message.
Under my economic plan, we will bring down the cost of housing and help first-time home buyers, giving them $25,000 for down payment assistance. We will lower the cost on everything from healthcare to groceries.
You've been eaten alive with inflation, and all I'm doing is getting you back to even. The farmers are very badly hurt. The farmers in this country, we're going to get them straightened out. We're going to get your prices down. By the way, no tax on Social Security benefits for the older people.
Here's the latest this morning. Kamala Harris and Donald Trump going all in on the key swing state of Pennsylvania with dueling rallies detailing their plans for the economy. This is Harris is scheduled to sit down Wednesday for her first interview on Fox News. And later this afternoon, Trump joining Bloomberg's editor-in-chief John Micklethwait for a conversation at the Economic Club of Chicago. Joining us now to discuss Bloomberg's Saleha Mohsin. Saleha, welcome to the show. Let's get straight into it. What are you looking for from former President Donald Trump a little bit later on in Chicago?
He's going to get some pretty difficult economic policy questions from Bloomberg's editor-in-chief. We're going to be asking him about where tariffs could go. U.S.-China policy is really important. The impact of a smooth transfer of power to the rest of the world. This is his second exclusive interview with Bloomberg this year. He sat down with Bloomberg Business Week in June over the summer. And so we've seen that he's not shying away from taking on mainstream media, asking pretty serious and tough questions.
Saleha, we just heard a clip where the former president talked about no tax on Social Security, and the crowd absolutely went wild. But you and I both know to get any of these provisions done, whether Kamala Harris is talking about some tax provision she wants or the Trump campaign, they need Congress behind them. What are you hearing from investors in terms of how they're looking at the composition of the Senate and the House?
You're exactly right, Anne-Marie. Investors are very clear-eyed about where tax policy is made. They realize that it's not just who wins the White House. In fact, the bigger focus should be on how the congressional races create the Senate, right, and the House side. So right now, it looks like investors are betting that Congress might end up divided, which means a little bit of a slower policymaking path under a Harris presidency that is expected to cause some rough and tumble moments when it comes to dealing with China, possibly tax policy, but also for Trump. Just because you have a Republican in the White House does not mean that House Republicans, which is what the House side is starting to look like it's shaping up to end up. The House side might not be fully on board with Trump's tax policy because they are increasingly worried about the deficit and they want more pay-fors than Donald Trump has talked about. So if investors are keeping a clear eye on what is going on in Congress, then right now it looks like a divided Congress scenario, a divided government in Washington. A clean sweep for either party is less and less likely. So there could be more tensions. Now, on the Trump side, that could also mean that, look, whether you have a divided Congress or a unified Congress, Trump is going to be leaning far into tariffs. But if Congress is dragging their feet, can't agree on across the two chambers on any kind of policy, that means that a president like Donald Trump is probably going to be leaning more on executive orders and administrative actions.
Saleha, what do you make of individuals like Scott Bessent, a key economic advisor of the former president, saying this isn't really carte blanche tariffs, this is negotiating salvos? What are your sources telling you?
It looks like people like Scott Bessent, look, he comes with a markets background, and he is regularly talked about as a potential Treasury Secretary. Bloomberg News was the first to mention his name as being on a list for Donald Trump. We mentioned that as early as spring. He comes with more of a markets mentality, and that's important to someone like Donald Trump, who historically has really cared what markets think about his policies, how they might react. And so if you hear people like Scott Bessent talking about pushing down some of the market concerns around wild policymaking, it means that he would be the kind of advisor to a President Trump that would keep markets in mind.
Saleha, I have to wonder how much we really have a sense of who the cabinets would be around each of these candidates, who they really would put around them to sort of signal how seriously to take some of their proposals. You mentioned that a lot of people in markets just expect that Donald Trump says a lot of things, but ultimately the stock market will provide the check on him. And some people wonder what that check will be from Kamala Harris. Do we have a sense, or is there any kind of coalescing of cabinet members or basically policies that are coming around?
Look, Harris has done far fewer interviews and media appearances with mainstream media, including Bloomberg. She's not sat down with Bloomberg the way Donald Trump has. So we've not gotten the opportunity to ask some of those tough questions about economic and foreign policy. That being said, Bloomberg News, I've reported that a Harris presidency is likely to be a little bit more pro-business than Biden has been. Joe Biden has quite often vilified Wall Street, and he's suffered a little bit from that. He has not had the kind of support from CEOs and corporate executives to really promote and push Bidenomics. And we've seen that message kind of felt flat with voters, as we saw before he stepped off the ticket. With Harris, we should expect, depending on how influential the progressive wing will be in a Harris presidency, a little bit more of a say and sway from the people who represent the business community. She's very close with people like former American Express CEO Ken Chenault. She has frequently spoken to Peter Orszag of Lazard during her vice presidency. Her brother-in-law is an executive over at Uber. So she does have deeper ties over there.
What's the final stretch going to look like? We have about 3 weeks, less than that, left in the campaign season. We've seen a real escalation in rallies, et cetera. We see a number of media interviews, including Kamala Harris, agreeing to interview with Fox tomorrow. What do you expect in the final rush?
I think we're going to see each candidate hit try to reach the constituencies that they're most worried about. You can definitely see that the Harris campaign has some anxiety around Black men, as we saw with former President Obama's messaging and direct comments to that constituency last week. Donald Trump seems to be heading to blue states, and you almost have to wonder if he is now not just hoping for an electoral college win, but also the elusive popular vote win, which he has not secured before.
Saleha, it's got to get your thoughts, as always. Saleha Motsin there of Bloomberg on the latest. I think that interview with Fox News is a big deal. Feels a little bit desperate. This is not somewhere where Kamala Harris would have gone maybe a month or so ago. Bret Baier's the real deal. Down the middle, tough, Very fair.
And he's given very tough interviews to the former President Donald Trump. This is going to be a tough interview for Kamala Harris. We've seen her sit down with some local media individuals as she's going through her campaign trail, and also members of the media like MSNBC, very, very friendly. But this is half the country. And if you want to win someone like a Republican that maybe was leaning towards Nikki Haley, you got to go on Fox.
They're certainly taking more risk in that campaign, that's for sure. Up next on the programme, we'll catch up with Ken Leon of CFRA as traders await earnings from Bank of America. Those numbers are just around the corner, with equity futures just a little bit softer from New York. This is Bloomberg. A lot of bullishness out there. 46 all-time highs on the S&P 500 so far this year. This from Bank of America this morning in the Global Fund Manager Survey. The biggest jump in investor optimism since June 2020. The biggest jump in growth expectations, global growth expectations since May 2020. Futures just a little bit softer this morning. Earnings still ahead. Bank of America just around the corner. We're down by 0.05% on the S&P. On the Nasdaq 100, we're down by a tenth. In the bond market, back open for business with a bid. Yields lower by 4 basis points on a 10-year, 4.06%. We're down more than 5 on a 30-year at 4.35. We need to talk about the comments from Governor Waller. We can talk about his view on rates. I thought he did something we were talking about yesterday on this program. We said on this show, when a Fed official is going to come out and lower the bar for payrolls for the month of October. Governor Waller did that, and he put a number on it. The disruptions that come from the hurricane, the strikes from Boeing. He says, I expect these factors may reduce employment growth by more than 100,000 this month.
And basically talking about if current economic conditions continue, they can proceed with moving policy toward a neutral stance at a deliberate pace. He did lower the bar. At the same time, he talked about not moving by 50 basis point increments. He basically was implying 2 more 25 basis point increments for the remainder of this year. That is my interpretation. That's not what he said verbatim. Interestingly, Neil Kashkari had the same type of commentary about the deliberate methodological kind of approach to lowering rates. So it seems like there is a consensus established right now on the FOMC.
Just setting the bar going into November and looking for a messy month of data this October. Let's turn the board, switch the page and get up to this. Get up to the commodity market and look at what's happening with Brent crude and WTI. Brent crude is down by something like 5% this morning, 73.76. It was a brief break of 70 on WTI, $70.15 this morning. We're down by close to 5%. Under surveillance, the Washington Post reporting Israeli Prime Minister Benjamin Netanyahu has agreed to limit retaliation against Iran. Netanyahu reportedly telling the Biden administration that he would strike military targets rather than Iran's nuclear and energy facilities.
And that's part of the reason why you see oil prices dropping this morning. On top of that, the IEA talking about plentiful supplies when it comes to what is actually happening in the supply-demand market. But that geopolitical risk premium that we've been living with off and on really for an entire year, but most recently after Biden came out, was very transparent about the fact that maybe Israel hitting Iranian oil facilities was actually on the table, and that was under discussion. And now with the Washington Post reporting, that's been put to the side. They're going to go after military facilities per this reporting, and that means oil prices can take a rest.
All I can say is it just shows how much people don't understand what they don't know about the Middle East. That you could see a 5% sell-off just like that over one report. The idea that the top tail risk that right now is perceived in that Bank of America Fund Manager Survey is geopolitics. How do you price it? It is entirely in the commodity market, and you can see it whipsawing as people's sentiments get buffeted around by different news reports.
It can change in big ways day to day. Just to stay on policy, this is some of the latest down in Washington. Sources telling Bloomberg the Biden administration has discussed capping sales of AI chips from U.S. companies to some countries. The policy would set a ceiling on export licenses for certain countries in the interest of national security, with officials focused on the Persian Gulf.
So it's taking the playbook they used from China per this reporting and using it in countries in the Gulf like the UAE and Saudi Arabia, even though Mohammed bin Zayed was just here, and they put out a release talking about that this is one area that they actually want to work together and collaborate with. What is interesting is this story from Bloomberg News, a scoop by Mackenzie, our colleague down in Washington, D.C., comes at the same time the Financial Times has an interview with the new head of Saudi Arabia's premier academic institution that works on AI chips, and they are promising to stop any AI collaboration with China that could jeopardize the university's access to U.S.-made chips. well, potentially that access is not going to be as carte blanche as they were expecting.
There are two issues here that I think are most interesting. The idea of backdoor access to China through the Middle East and how much the U.S. is trying to crack down on this, right? How much is this an effort to prevent shipments from the U.S. to the Middle East to then China? But then also a lack of understanding of exactly how these chips are going to be used for AI developments in the Middle East. An idea of what that surveillance looks like and trying to extrapolate out who our friends are going to be and who the enemies will be. A very difficult kind of needle to thread.
Lisa, I think you're absolutely right about constraining the access between Iran, China and Russia too.
That's really part of the issue, is that who is your ally? Can you really be confident that the Middle East will not necessarily be a conduit to some of these other places? Because as you pointed out, as you sort of were applying here, we've seen that playbook already with the likes of oil, with the likes of weaponry and other types of supplies.
Wanted to squeeze in an update on Boeing as well. So here it is. The US Acting Labour Secretary Julie Su meeting with the leaders of Boeing and striking union workers too. The union saying Su urged both sides to move forward in the bargaining process over a new contract after talks broke down just last week.
So really, the United States, you can tell the government wants to get this done and over with. They want to see these workers back at the plants, especially given the fact that Boeing is just not an important company to the U.S., but it is critical to the U.S. industrial base. Julie Su, though, has not been able to get confirmed at the Senate, yet she's doing a lot of the heavy lifting when it comes to not just what's going on right now at Boeing, what happened with the dock workers just a few weeks ago. She was the individual that was able to get that across the finish line, and also October of last year, healthcare workers. So she is the one that's doing all this negotiation as the acting labor secretary.
Like Marty Walsh in the seat before her, union background, which seemed to be the focus of this administration when it came to that seat.
Yes, and potentially that is why maybe she is actually so good at this. She has the support and really the heart of the unions, and they feel like maybe they can trust her. So if she's coming down and saying, come on, guys, you have to give a little, get back to work, let's get it over the finish line, she's been successful in it.
Boeing in the pre-market up by 2.5% this morning. Let's turn to the autos. A major European car maker is getting absolutely slammed this year. The BMW CEO sharing his concerns over the EU's plan to effectively ban the sale of combustion engine cars from 2035, saying it's no longer realistic. Bloomberg's Ollie Crook joins us now for more. Ollie, you've been at the Paris Auto Show. How much of a reality check have these automakers had to confront over the last few days?
Well, listen, John, we talk about crises, particularly in Europe, but around the world, that sort of begin slowly at first and then happen suddenly. And I think that now in the last few months for the European auto sector, we've really entered into the suddenly period of time. And what the BMW CEO is referring to is on top of all the difficulties you have in terms of global demand, you also have these new EU regulations that kick in at the end of this year, which basically require all these car companies to sell about a fifth, 20% of their cars to be EVs in order to be compliant with emission regulations. They're stuck right now below 15%. So there's a huge mismatch between what the policymakers want and what the market wants. And the question is, how do you close that gap? BMW is suggesting that you need to push out the regulations. You spoke to Carlos Tavares yesterday. He says, actually, no, what we need is policy certainty, but we need a little bit of stimulus on the demand side to get things where they need to go. The point is, none of these European automakers are really prepared for these regulations kicking in at the end of the year. The only company really well positioned for that is kind of Tesla, because they have both manufacturing locally within Europe and obviously only produce EVs, so they can actually sell credits to these other automakers.
Ollie, you mentioned Carlos Tavares of Stellantis, who spoke to us yesterday, and he was standing in front of cars that were made with a joint venture from a company in China. How much of the presence did China have at this auto industry conference, given the fact that a lot of different Chinese manufacturers are moving output to Europe to get around some of the potential tariffs?
So, Lisa, this is really interesting because we had a contrast from the car show in Munich last year, in September of last year, the IAA, where you really had this sort of coming out of all of these companies, sometimes for the first time in Europe, BYD, Xiaopeng. These are now staples at these car shows. These are all over the place. I'd say more than 85% of the cars that were shown were EVs, and a huge proportion of them were Chinese. And I think the Leap Motors is an extremely good example with Stellantis, because what they are doing now, basically, the Chinese model is adopting what the German model was in the 1980s in the Chinese market. We're talking about a joint venture. Stellantis owns 51% of that company and their distribution within Europe to basically get into the market. The difference is that the Chinese were very welcoming of this in the 1980s because they had no automotive market. Here in Europe, you have an automotive market, and one of the last sort of industries within Europe that was really sort of considered to be globally at the cutting edge, and that is now being threatened.
Oliver, also, we've seen that in the United States when it comes to the Japanese automakers in the 90s. How much time do these companies have? When are we going to start to see actually factories close their doors?
Yeah, so listen, this is a question that is before all of us right now, and the answer is it's happening right now, which is back to the earlier point, the slowly at first, and then suddenly, we're in the suddenly. We have Volkswagen that's talking about closing factories in Belgium, maybe 2 or 3 within Germany. We're cutting about 30,000 jobs. That is happening right now, and this is because this business model is just not fit for purpose for the reality sort of going forward. So you can delay some of these regulations on emissions, keep the lifeline of the ICEs going for a little bit longer, but it doesn't answer the fundamental question, which is how are these companies going to stay competitive? And again, at a backdrop, I'm here in Brussels right now with EU policymakers really grappling with the question of how to keep this continent competitive and really not be sort of cast out to the sort of irrelevance of sort of economic obsolescence. And the car sector is really at the forefront of this, really on the front edge of this, and they really don't want to be the textbook case of how Europe lost all of its industry.
Ollie, appreciate the update, sir. As always, Bloomberg's Ollie Crook on the ground out of Brussels this morning. We've mentioned this on this programme a few times. In fact, this conversation goes back a number of years. They have really screwed up the auto sector in Europe. Policymaker after policymaker burying their head in the sand, virtue signalling around green and environmental issues. And I'm not here to say that they shouldn't have been focused on. They should be, clearly for very real reasons. But these targets were always unrealistic. And they've always been unrealistic without the state aid to go along with them. Never mind the infrastructure that these kind of automakers demand at the moment. And they go on programs like this and repeat again and again and again. But the capacity issue now, we're at this point where they've got to make a decision. And we heard that in the voice of Mr. Tavares yesterday of Stellantis. We're talking about months before we get serious cuts to capacity across the Euro auto sector.
And what I really felt yesterday, and I'm glad that you went there, this feeling of urgency on that side, but not real clarity when it came to any consensus on what those policies would be. And, oh, yeah, there is a bit of hands being tied with respect to the fiscal oversight of some of this, given where we have just come from.
The quote that stood out to me with both your guys' interview with the Stellantis CEO yesterday was, "We're not seeking to sell any of our brands right now. We're not seeking to sell brands right now." Clearly, this is something that potentially they're thinking about, because how do you make money in this type of environment? They're looking at potential options.
We showed some of the stock prices, absolutely brutal so far year to date for the likes of Stellantis, for the likes of BMW. Big bank earnings continue to roll out today. We'll get Bank of America in just a few minutes' time. Goldman Sachs and Citi reporting later on this morning. Ken Leon of CFRA joins us now for more. Ken, we're waiting for BofA. It's just minutes away. What are you focused on when those numbers drop?
We're looking at a lot of things. The first lens is really banks have been an important part of the financial sector, which has moved with the S&P 500 very strongly. So we want further confirmation that the business is good. The economy, everyone will be looking at the consumer, where generally we're not seeing credit risk fall off the cliff. And third will be the dynamics of rates. Rates from the standpoint that for Bank of America, 54% of their total net revenue is net interest income. So that the flywheels for that are simple. It's the economy, which is really loan growth, and then, of course, rates coming down. So I think in totality for Bank of America, they're mostly going to be talking about not only corporate, but also the consumer being still pretty healthy. Additionally, it's kind of window dressing is back a year ago, they had over $100 billion of unrealized net losses. And this was the mismatch, related to their unrealized bond losses. With rates coming down, that's going to benefit that. But that's not really a key mark for looking ahead. So banks, again, I think what we're looking first is these three areas. And then as we have Goldman Sachs later today, Morgan Stanley tomorrow, whether there's a separation of performance between the large commercial banks, if you will, Bank of America, or clearly what we've seen with Wells Fargo from these type of banks.
We're just minutes away, Ken, from getting Bank of America. Then the calendar looks like 45 minutes later, Goldman Sachs. John, we are getting some numbers right now, but to me, very curious to see the separation, as Ken was saying, between the behemoths like Bank of America and the likes of Goldman Sachs.
When these numbers drop, you just get a ton of numbers. So we'll work through them headline by headline. Lisa, I'll go first of all to what you see from the likes of investment banking. Revenue coming in at $1.4 billion, the estimate $1.24 billion US dollars. So a big upside surprise there. That's investment banking for the third quarter. Revenue $1.4 billion, the estimate $1.24. Lisa, what else do you see?
Net interest expenses, non-interest expenses came in just a little bit light again. You see FICC trading revenue coming in at $2.94 billion. That exceeds expectations of $2.77 billion. You could see also a beat for equities trading of $2 billion versus the estimate of $1.8 billion. This is the key number, net interest income. And it is a beat, and this was what a lot of people were looking for. Almost $14 billion, $13.97 billion versus the estimate of $13.9 billion. Basically, the same thing we've seen across the board when it came to JP Morgan and for the most part, Wells Fargo. These banks are doing well with a yield curve that is disinverted and a consumer that seems like it's pretty strong.
Trading revenue, upside surprise. Investment banking, upside surprise. Net interest income, upside surprise. Just to repeat that net income headline once again, $13.97 billion US dollars. The estimate, 13.9. You're going through the same numbers, Ken. What's your take this morning?
We are. So they hit the big metrics, which is great. And then looking further into the results, what we're going to be seeing is whether there's continued confidence in terms of generating non-interest income or service revenue. There's a lot of businesses that Bank of America have that generate revenue and earnings that are important. They're in areas of treasury services, custodial services. You know, this notion to get higher stock prices is having durable, recurring revenue. And obviously, that doesn't really, you can't control rates, but certainly the other businesses and serving their customers is critical. I think the cost side will be another factor. There's a lot of investment for Bank of America in technology. Some of the other banks besides technology has been regulation. So the efficiency ratios and their ability to have revenue outpace costs will be important, especially as rates come down.
We did see across the board for the headline numbers pretty much beats. This was sort of interesting to me, just in light of what we saw from JP Morgan, that provisions for credit losses in the third quarter came in just a touch above the expected $1.53 billion. It came in at $1.54 billion. Ken, are these big banks building reserves because they can, or because they expect weakness, or because they're being more aggressive with the loans they're making?
Yeah, it's a great question. And JP Morgan Friday, I think, was $3.1 billion. They're building reserve partly and partly taking some credit losses, but it's mostly focused at credit card and consumer. For JP Morgan, I didn't see Bank of America, but JP Morgan, it was about 85% of that reserve was related to credit card. So again, Bank of America has a great franchise there. But my comment before, it's okay to build reserves and take some credit losses in credit card, providing the flywheel of loan balance activity increases is not flat to down. That's a sign of a healthy economy and consumers that are still spending, hopefully prudently.
Hey, Ken, stick with us. Stay close. Ken Leon there of CFRA following numbers from Bank of America. Stock is down by 0.8% of the pre-market. Bit of context. Some recent moves. Friday was up by something like 5% off the back of the numbers we saw from JP Morgan and Wells Fargo.
Yeah, this is basically a bar that got kicked upward pretty dramatically after JP Morgan and Wells Fargo. To Ken Leon's point about loan balances, it came in basically in line. So $1.08 trillion versus the estimate of $1.07 trillion. How much is that basically? They just didn't beat enough. Is that essentially what we're seeing?
Quite a few beats across the board elsewhere. Bank of America right now, just a bit softer in early trading. We're down by something like 0.5%. With an update of stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg reporting that Chinese tax authorities are moving to collect overseas investment gains from the country's ultra-rich. They've begun to ask individuals to come in for payment evaluations or request a self-assessment. The government has been urgently trying to expand its revenue sources. Land sales have tumbled while growth has stalled. EV chipmaker Wolfspeed will be awarded $1.5 billion in grants from the U.S. CHIPS Act and the private sector. The grant will come from the CHIPS Act, will cover a portion of the over $6 billion in planned spending for factories in both North Carolina and New York. The Biden administration says that those projects could create over 5,000 jobs. The grant spurred a wave of financing from the likes of Apollo, who will match the CHIPS Act's grant of $750 million. And in sports, the Mets secured a much-needed win in the second of the NLCS at Dodger Stadium. After dropping the series opener 9-0, the Mets responded with a strong showing led by star shortstop Francisco Lindor. And the Yankees are off to a promising start in the ALCS, winning Game 1 by a score of 5-2. Yankee starter Carlos Rodon delivered his best performance in pinstripes so far, with home runs from Juan Soto and Giancarlo Stanton sealing the win for the Bombers. And that's your brief, John.
Hey, Danny, thank you. Appreciate the update. This Subway Series is a very real threat, isn't it?
Oh, yeah.
This rivalry between the two of you.
It might get pretty ugly.
Let's just remember the last World Series, Subway Series in 2000. Who won? Yankees swept the Mets.
Yeah, but right now they're doing a little bit better and they look good.
Okay, this is going to be great if this works out. Up next on the program, I'm not picking a team. I've got a team, but I don't care enough to share it. Big bank earnings rolling out on Wall Street.
I suspect that given the volatility that we've seen, especially in the equity markets, I think broadly speaking, you'll see potential upside surprise in trading this week.
Another upside surprise, this time from Bank of America. That conversation up next. AMH wants me to wear one of those caps that Eric Adams wears. Half Mets, half Yankees.
I think that's a little too soon to
Well, no,
really
I really want you to wear
Eric Adams in any way, shape, or form.
I really want you to wear a Yankees cap because I think that hat is
quit it.
appalling.
Just stop it.
But if you had to on this show, you know,
Really?
you could have the Yankees on the right side of the cap and Mets on the left for Lisa.
Okay, cool. I'll ask Mayor Adams if I can borrow the cap.
Yeah, why don't you do that?
Yeah.
We'll video that.
See if he gets back to me. Under surveillance this morning, big bank earnings rolling out on Wall Street.
Broadly speaking, both trading and banking dynamics were a little bit better than expected at JP Morgan. They're the best in class. I suspect that given the volatility that we've seen, especially in the equity markets, I think broadly speaking, you'll see potential upside surprise in trading this week.
You got another one this morning. Here's the latest from Bank of America. The results dropping just moments ago. The company with a slight beat on net interest income, an upside surprise on trading revenue. We'll get Goldman and Citi a little bit later this morning. Ken Leon of CFRA is back with us. Ken, 7:30, Goldman. I think 30 minutes after that, Citi. What are you focused on for those two names in the next hour?
Well, that's our call. It's really that the capital markets, particularly underwriting and M&A, is going to drive fees. And of course, Goldman, you get that outsized impact as you do with Morgan Stanley versus the banks so far. I think it's enormous that what we've seen so far is no deterioration in investment banking. Actually, we've seen modest growth in the third quarter, even for IPOs. But we're seeing that there's, I think, a realization that rates aren't going to zero, but financial sponsors, which have not really been in underwriting or M&A, the Blackstones, the KKRs, are saying that we can now monetize sizable assets or equity that they have. Sizable means $1.2 trillion have to be monetized in the next 18 months.
Yeah.
All this for Goldman is going to be phenomenal. First, as an intermediary, and second, because they're expanding their business into private equity and private credit. So there's some dynamics of Goldman and Morgan Stanley that you just don't get the same weight or impact for JP Morgan or a Bank of America.
Hey, Ken, looking forward to breaking down the numbers with you. 7:30 Eastern Time, Goldman Sachs just around the corner, 35 minutes away. That was Ken Leon of CFRA. Mohammed Al-Arian writes in, he wants to try and get me on the Mets bandwagon. Only if Stevie Cohen pays.
Yeah, well...
Like a baseball mercenary.
Oh, yeah? So what would be your paycheck that you would need to be a Mets fan, to day in the Mets with your fandom?
I need transport paid and a free suite to take all of my friends.
You're a Yankees fan.
That's ridiculous. Honestly, all I can say is that Uncle Steve has done a great job with the Mets. And I will also say that, you know, if push comes to shove, things can, things will be flying at this table.
I am a Yankees fan. I just want everyone to get along.
What does a fan mean?
I just want everyone to get along.
Fan.
Sarah Hunt of Alpine, Saxon Woods joins us next. Tobin Marcus of Wolfe Research. Ken Leon of CFRA will be back with us to break down bank earnings. And Stephen Cook of the Council on Foreign Relations.
The market is sort of punishing the more expensive stocks for the higher rates.
The market is effectively just like the Fed is watching every data point.
Data always matter, but 1 month does not change the narrative.
From the Fed's perspective, look, if the economy's in good shape, we can just gradually bring rates back to a normal level.
Whether they cut 50 or 25, last meeting is less important. What's more important is just the steady path.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Lots to work through this hour. Goldman Sachs in about 30 minutes' time. Numbers from Citi 30 minutes after that. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P just about turning positive on the S&P 500. Coming into Tuesday on a 2-day winning streak. The Nasdaq just about unchanged. Good news is good news. What else is good news? No news is good news. And from the banks so far, no bad news at all, really, from JP Morgan, Wells Fargo, and this morning, Bank of America.
I would actually argue it's been pretty much beats across the board with good news. And even when you had Wells Fargo coming out and saying we looked for some consumer weakness and we couldn't find it, that just was emulated by what we saw from JP Morgan as well as Bank of America. Key question, and this is something that Ken Leon alluded to. Look for this in Goldman Sachs' earnings, how much they're partnering with some of the behemoth private equity and private debt companies. This we didn't talk about. Bank of America third quarter debt underwriting revenue was $332 million versus the estimate of $669 million. How much are they losing share to some of these other players?
I'm interested in the bank earnings, just basically the temperature and what's going on with the consumer. JP Morgan's talking about that consumer still going out and spending. Bank of America, when we recently caught up with the individual that's looking at some of the consumer-driven parts of the bank, where are they going out, where are they spending? It's still maintaining. This American consumer is maintaining the idea of going out and spending on services like restaurants. Bank of America is still looking at this. Giant consumer banking, B of A, showing flat total charge-offs for the quarter and actual declines in credit card losses. Still, non-performing loans increased modestly, $5.6 billion.
The overall message from the major players is that things are okay for now. We'll wait for Citi, we'll wait for Goldman. That's the overall message from the major players. What do the smaller and more regional-sized lenders look like? What do the Ally Financials look like this earnings season?
The Capital Ones, we heard from Ally Financial. It was a warning heard across Wall Street. Everyone took that more than all of the sanguine commentary from some of the big banks. Still a question mark. That said, we're hearing from across the board not a lot of negativity, which is the reason why good news is good news, no news is good news, and the marginally bad news is good news because that means that the Fed put comes back into play.
All news is good news. Equities at all-time highs on the S&P 500. Why do we even have a show? Futures on the S&P up by not even 0.1%, just about turning green. The bond market back open for business with a bit of rally. Yields are down by 3 basis points, 4.07%. The standout move on the screen right now, crude, down by almost 5%. Earlier on in the session, it was a break of 70. AMH, the focus on a Washington Post article overnight.
That's right. And this focus from this article is that they have reporting that Israel may avoid targeting Iran's nuclear oil facilities, oil infrastructure. So that eases this geopolitical premium we've seen put into the oil price. And then the oil market is just focusing now on the supply and demand picture. And what do we see? There is ample supply in this market.
To the degree that people are looking for bad news, which we heard marginally that they are, which is also making people bullish because they're still looking for bad news, the geopolitics has been it. And when you take that off the table, or at least lower the temperature, how much does that just open the door to a 47th record high on the S&P 500 or a 23rd record high if you look at the equal weight?
Down more than $3 this morning, $70 and about 30 cents. I love that you're counting equal weight all-time highs now.
I'm never going to let that go. You actually caught me that I didn't know.
It's a question you didn't know the answer to.
I didn't know the answer to it, and I was emphasizing the importance of the equal weight, so I need to live by my words.
It's 22.
Well, it has been 22. This will be 23rd if it goes today.
Okay. 22 and counting.
Yes, correct. Thanks.
Coming up this hour, Sarah Hunt of Alpine, Saxon Woods with US stocks at record highs. Ken Leon of CFRA with results from Goldman Sachs due later this hour at 7:30 Eastern Time. And we'll speak to Stephen Cook of the Council on Foreign Relations on that move in crude. We begin this hour with US stocks at all-time highs as earnings season resumes on Wall Street. Sarah Hunt of Alpine, Saxon Woods saying with earnings multiples at robust levels, any faltering in the growth story could have negative consequences, even if it is more of a stable outcome versus a deterioration, earnings growth is key for equities. Sarah joins us now for more. Sarah, good morning.
Good morning.
It's good to see you. What do you make of the banks so far? Big week of gains last week off the back of JP Morgan and Wells Fargo. Numbers from Bank of America about 20 minutes ago.
I think that is a good start, and I think that has obviously been heralded fairly well. I mean, you saw the other financials besides JP Morgan move higher on Friday. I think to your earlier discussion, it's going to be very interesting to see how the credit companies do, or how the banks do with the lower credit score folks, because I think that's where you're seeing much more pressure and pain than you are seeing in the upper end. So we'll see how that goes. But I think that the fact that you're seeing enough spending and that the consumer looks good, and even if you're looking for it, you're having trouble finding it, I think that's good news.
Sets up retail sales on Thursday as well. Any reason to think that we come in soft on retail sales, given where the consumer is?
I think that's hard to see right now, but I mean, you might have some areas of softness, but I think in general, people are still spending fairly well. It's too early to catch up for all the economic disruption that the hurricanes had. So I think that you probably are going to see reasonably good numbers.
So this is what a lot of people are expecting, that the consumers have plenty of money and that any degree of weakening, even in the savings rate, has been really tampered down by some of the recent revisions. What's stopping you from just going full bull?
Well, I think there's still a lot of things that we don't know. There's a lot of uncertainty out there. We've got an election coming up. Yes, it seems like things have calmed down a little bit in the Middle East, but is that calm going to remain? And just because we've got reports of that doesn't necessarily mean that we know what the outcome is going to be yet. So I think that there is enough out there that you could be concerned about. And I think that you have next year a big expectation in earnings growth. So you want to see that economy continue to roll along fairly nicely. And I think that there's, like I said, there's enough out there that you could get yourself upset about or scared about, including the deficits and things that we're not talking about right now. But at the moment, that's not the focus. So right now, that's good for equities.
You're basically describing the story of my life. I can go home and worry about a lot of stuff, but you come in the next day and nobody really seems to care about it. I am wondering whether we are seeing the risks getting skewed to the upside in terms of economic growth. We were talking to Max Kettner, who was talking about the real tail risk to him is actually an upside to inflation and a reignition of some of the price increases that we saw, that this could actually create the doomsday scenario that could actually stop some of the euphoria that we're seeing in equity markets. Is that the risk to hedge right now, given the lack of visibility of any other risks, particularly with respect to the consumer?
I think it's a big issue. I think the fact that oil prices have come down so sharply helps a little bit on the inflation front. But I think that that's one of the areas that if you see, you saw an upward CPI print just a little bit and all the directionality sort of shifted. And is it a full shift? Is it a small shift? I think that is one of the bigger risks because that's going to keep the Fed from acting as decisively as it could if you have any weakness in the labor market.
So where do you want to be in equities right now? What's your favorite place to be?
I think you want to be sort of across the board, which sounds really boring and annoying.
Is that Lisa's equal weight?
Well, I don't think you want to ignore the equal weight the way that you did the last time, right? So before it was all about technology stocks. And if you're underweight technology stocks, you were underperforming really badly. I think at this point, the diversity and the fact that you need technology, but you also want to see what else is going on in the economy, I think that's really come back. And I think that that's why you want to be somewhat across the board as opposed to having all your eggs in the technology side.
Is there a theme that you want to run with? This is what Mike Wilson and Morgan Stanley was talking about on this show, that we moved from GLP-1s to AI, this big NVIDIA move over the last few years. Is there another theme you want to run with that works right now?
I think that it's good to understand what is going on with thematic investing. I think that what you're seeing with the European car makers right now is they're saying, hey, hang on a second, we're not going to be able to go full EV in 10 years. That's not going to happen. I think understanding the fact that you're going to have an and on the energy front is going to be important. I think it's important on a thematic sense to look at companies that have continuously good balance sheets and can really generate cash, because that's what's going to be more problematic. Even if rates don't come down dramatically but stay a little bit higher, you're going to start to see some of those companies that can't survive on their own have more problems. And it hasn't really been an issue yet, and credit spreads are really tight. But I think that focusing on companies that are able to do things like buy back their shares and pay dividends is going to continue to be very helpful.
You mentioned the U.S. election. In your notes, you talk about the political risk and volatility for equities. What happens when we don't know the outcome for potentially days or weeks?
I would not like to see that happen. I don't think markets would like to see that happen. I think if it looks like any kind of protracted fight, I don't think that that's going to be healthy for equity markets. But at the same time, we're almost, inured is not the right word, but we have had problems before and we have gotten through them. So to the extent that we've had challenges and yet we've all come back to a point where there is an acceptable answer, I don't think it's as bad as it could be, but I do not think that equity markets would like that very much at all.
But are they even pricing in this probability right now?
I do not think that. No, I don't think so. I think that they're not even pricing in a probability of a sweep of one side or the other. I think they're still pricing in a probability of a mixed government because that's generally better for equities because things don't move as fast, right? You can't make changes as quickly.
So the equity market is pricing in what they would like to be the outcome, not potentially what is going to be the outcome.
Mm-hmm.
Yeah, that's pretty
dangerous. And that's very
no?
equity market-like, though, isn't it? I mean, isn't that what equity markets do? It's like, what do we want to happen? We're going to try to telegraph that and make it happen. You know, if we keep moving this way, maybe thus it will be so.
We are deep in the heart, we're getting to the heart of earnings season. Which sector are you most interested to hear from? We've already heard from some of the banks. We're going to be done with basically the big bank earnings by the end of tomorrow. Which really will be the company or slew of companies that give you the best sense of whether people are a little bit over their skis in terms of risk?
If you think about what's going to drive what we think about the consumer, you're going to be looking on all the consumer side stuff. But if I think about the entire economy, I want to hear what the industrials have to say. And I want to see what they have to say about margins, what they have to say about labor costs, material costs, because that's going to set us up for 2025. And that's, I think, the big question. It's like, okay, we've seen some really good earnings growth in 2024. We're expecting more earnings growth in 2025. Do we have the underpinning ability to do that and to get those earnings through? Because if we do, then the bullishness is not wrong. But if you're starting to see cracks in that, and you saw individual, is that idiosyncratic? Is Nike having a problem because Nike's having a problem? Is this having a problem? If we see broader problems like that, I think that then the question starts to come, what's happening next year? If you don't and you see much more stability and you see companies saying, hey, you know what, we've really got a handle on these costs and we're able to push prices just a little, just enough to keep margins in good shape or growing a little bit, I think that's going to be important.
Is there any sector that you're just completely avoiding?
Not at the moment, but I think that there are places where you want to be careful. And you're always looking for companies within individual sectors that have their own dynamics. But at the same time, I think some of the consumer, you have to be a little bit careful for reasons like Nike and the individual idiosyncratic problems that you can see. But I don't think that there's anything that you would say, absolutely, I want to stay away from here. I mean, it's interesting that the IEA is taking numbers down for demand, and yet we're taking global growth numbers up for China, right? So one of those things is not correct. Where you go from there, I don't know. Materials have certainly been hit pretty hard on the back of both oil coming down and some of the other stuff. But I don't think that you want to be completely out because there's still places to make money in those sectors.
Sarah, it's good to see you. Sarah Hunt of Alpine, Saxon Words, looking ahead to the rest of earnings season. Tech players always dominant. Big focus on that. You mentioned Capital One, October 24th. And then the likes of Target, back end of November, going into the shopping season for the holidays. It's going to be a big, big theme for us going into year end.
And you start to wonder how much we're going to hear lots of idiosyncratic stories. Sarah was talking about that. We really, I think, need to focus more on the consolidation of market share in the biggest players as they get an increasing amount of power just because of the data and their tech types of networks. I'm thinking of Walmart in particular, how much that's going to be a piece of the earnings as well.
Consumer and consumer credit.
Yes.
Seems to be where a lot of people are focused on this earnings season. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Boeing plans to raise as much as $25 billion, filing a shelf this morning as a precursor to a possible equity raise. It also announced a new $10 billion credit agreement to shore up its balance sheet with the strike still ongoing. Boeing is working to hold off potential ratings downgrades from both Moody's and S&P, both of which have threatened to downgrade Boeing to junk status. The S&P estimates that the strike is going to cost the company more than $1 billion a month. And German investor confidence has improved for the first time in 4 months. Expectations index by the ZEW Institute rose to 13.1 in October. It was at 3.6 the previous month. Hopes for stable inflation and future interest rate cuts by the ECB were both factors in the rising optimism. And panda diplomacy has returned to Washington, D.C. A pair of giant pandas are en route from southwest China to the Smithsonian's National Zoo, where they will stay for 10 years. The 3-year-old male and female pair named Bao Li and King Bao will be the first pandas that reside in the nation's capital since last November. It's unclear when exactly they arrive, but China's Wildlife Conservation Association said that the food prepared for the trip includes cornbread, bamboo, and carrots. And that's your brief, John.
Danny, thank you. TikTok and pandas. A threat to national security.
Well, yeah, they're pandas. Honestly, there's a lot of passion around pandas. I get it. They look like stuffed animals, but they also don't really move very much and tend to.
Oh, you're not a panda fan?
Well, look, how can you not be a panda fan? They're adorable, but there's a lot of focus on them. I'm just saying.
I brought my nephews to see the pandas before they went back to China, and they were moving. One of them was running around. It was amazing. Also, you know what this means? Panda Cam is coming back.
Oh, exciting stuff. Okay. Up next on the show, not that. Seeking a battleground edge.
Under our plan, we will lower the cost on everything from healthcare to groceries.
Everything's going to come. It's going to be beautiful. You're going to have a house. Just wait a little while. Give me a little while. Let me get in.
A conversation up next, live from New York City this morning. Good morning. Equity Market Bull writes in, next time I'm on, I won't say who, ask me about the pandas next time. Makes me even more bullish having seen that now.
All I can say is, well, first of all, look, they're cute. I'm getting a lot of hate mail. I just want to let you know they are cute, but they kind of have failed Darwin. Just want to say.
Propaganda machines.
Okay.
That's what they are.
Okay, really, we're just going to get lots of hate mail.
Influencing international views of China at a time where there is serious tension between China and the United States and the Western world. What else are they?
You're going to die on this one. Keep going.
I'll take you there when it comes to TikTok, not when it comes to the pandas.
You don't think pandas are being used to influence diplomatic relations at all?
Potentially, it's a friendly diplomatic olive branch.
Okay.
But
to reshape views and opinions of China?
I think we're reading into the pandas way too much.
Okay.
They're adorable. You can go to the museum. We'll now have a panda cam back, which I'm very excited about.
Kung Fu Panda.
And that's really the end of it.
All right, I'll come with you. Futures right now on the S&P 500, just about unchanged. Under surveillance this morning, seeking a battleground edge.
Under our plan, we will lower the cost on everything from healthcare to groceries. Look, I'm going to take on corporate price gouging just like I've done before. I'm going to do it again.
Everything's going to come. It's going to be beautiful. You're going to have a house. Just wait a little while. Give me a little while. Let me get in. 1 year from January 20th, we will have your energy prices cut in half all over the country.
That is quite a claim. Here's the latest this morning. Kamala Harris and Donald Trump promoting their economic plans in key swing state, Pennsylvania. With more remarks on deck. Fresh on the schedule, Harris sitting down Wednesday with Fox News for the very first time. Tobin Marcus joins us now for more from Wolfe Research. Tobin, welcome to the programme, sir. I want to get to that interview on Wednesday. It feels like this campaign is taking more risk on the Harris side. What do you think is behind that?
Yeah, I think they've correctly assessed that they are not going to win this election by playing prevent defense and sitting back and, keeping her out of the spotlight and hoping that Trump will self-destruct. Trump's favorability is higher than it has been in cycles past. So I think he has vulnerabilities. He's certainly beatable, but it's going to require them to keep reaching out to voters, trying to win votes. Polls still show that a lot of voters feel like they have questions about her. They need to know more about her policies, about what she stands for. And then there's this sort of meta objective of showing that she's willing to stand up to tough questioning, that she, can go into adversarial environments and hold her own. So, I think that's the calculation. These interviews she's been doing in this recent media blitz have not been flawless, but I do think that the strategy or, the strategic assessment is correct, that she needs to make the attempt to go out there, reach more people, do more things, and let the chips fall where they may.
Tobin, when she sits down with Bret Baier, Fox and Bret said last night in his show that they're going to air the entire interview 30 minutes straight, even though they're pre-recording it. The one concession they said they gave was basically just the timing of this, that they would pre-record it at the 5 o'clock hour and his show's at 6. What part of the electorate, though, is she going after with this interview on Fox?
So, I think part of the objective is showing she can do it. So it's a message that's sent even to non-Fox viewers. And of course, it will be clipped and consumed by people who are not sitting down and watching linear Fox in the primetime slot every evening. But, I think there are swing voters out there. It's not a big slice, but, you think about, for example, kind of college-educated white voters who may have been Republican voters in cycles past, like that type of voter in the suburbs of big cities, the suburbs of Atlanta, for example, they've been drifting left. Those are winnable voters for Democrats, but not a block that Democrats have completely locked down. So, even though obviously it's a conservative-leaning viewer base, I do think that there are potentially persuadable voters for both Harris and Trump within most slices of the electorate, which is, why we see them doing this pretty diverse mix of media outlets that both of them have been doing, including non-traditional stuff like podcasts.
Tobin, what we saw after 2016 is that the polls continuously discounted and underweighted that Trump vote. Is there a chance that polls are underestimating Harris right now?
Yeah, I mean, my view has always been that the possibility of polling error is basically symmetrical. Like some kind of error will probably be in the polling. It's unlikely to be completely spot on, 100% perfect. There's been a lot of conversation about the possibility of another error underestimating Trump, which is a very real possibility. But I would not be at all surprised to see polls underestimate Harris either. I think if so, it's largely probably going to come down to turnout. I don't think that the story is going to be that there are a bunch of quote unquote shy Harris voters. But Trump all cycle long has been relying more heavily than Biden and then Harris on lower propensity voters. These inroads he's been making among Black and Hispanic men, for example, that have gotten a lot of attention, that's largely among kind of relatively less politically engaged people who are thinking about voting based on pocketbook considerations. And they might turn out for Trump and they might not. So, if we do see a little bit lower turnout, I think that's probably how we would get a polling miss that turns out to overstate Trump's support rather than understating it.
The vice president is going to go on Charlemagne the God today. And over the weekend and yesterday, we talked about her talking about economic opportunities specifically for Black men. One, is any of this possible? And two, is it going to land?
You mean, is it possible in terms of actually getting it enacted?
Yes.
Yeah. So, I mean, some of the, elements of the policy agenda that she's rolled out, sort of specific little package of policies aimed at persuading Black men who have, where, again, there has been some erosion. There's a lot of attention, for example, yesterday to her promise to protect digital assets. Right? That's kind of a promise not to do anything. That's a promise she probably can keep to the extent that there are folks in that slice of the electorate who are concerned about their own crypto investments. I think trying to neutralize the advantage that Trump has had there is something that she can credibly do. But, across most of her agenda, a lot of it is promises she's not necessarily going to be able to keep based on the composition of Congress. Of course, she has to run on something. I think she wants to hold out a vision. I think it does matter to voters to hear kind of what you stand for, what you would like to do, even if you're not necessarily going to be able to do it 100%. But if she does get elected, it's going to be a really interesting couple of years with her likely facing divided government as she, does not succeed, I think, in getting done a lot of these ambitious fiscal proposals. And then also have to see how voters react to that sort of mixed record.
The blitz has been ongoing and continues for the next few weeks from both what we hear from Trump as well as Kamala Harris. What do you ascribe to this shift that we've seen in prediction polls, where now suddenly Donald Trump seems to be outperforming Kamala Harris?
Yeah, so there's been a little bit of a tightening of the polls. So, the polling models have moved a couple points in Trump's favor. The prediction markets have swung more dramatically in his favor. We do just see vibes in prediction markets sometimes. In late 2022, so in the October before the last election, for example, we saw prediction markets buying more into this red wave narrative than it was ever showing up in the polls. That's something I was skeptical of at the time. And we ended up in a situation where prediction markets were much more confident the Republicans were going to flip a whole bunch of Senate seats than the polling models were, and turned out to be wrong. So, I think that there are probably some big players who have recently become more convinced of Trump's path to victory. I do think there's been some shift in the conventional wisdom. Anecdotally, Democrats are more nervous. Democrats tend to get nervous a lot. So I don't know how much that says about the objective state of the race. But, I think there were in some quarters an expectation that Harris would keep expanding her lead. We see some of the commentary and it's like, oh, her campaign's plateaued. Her momentum has stalled out. But I don't think it was ever realistic for Democrats to expect her to open up like a 5 or 6 point national lead. I've always thought this is going to be a close election. The polling that we're seeing now, I think, is not that far off of the realistic best case for Democrats. Yeah, I think we're headed for a tight one. And to the extent that people think tight polling means Trump's going to win, I think that's what we're seeing in betting markets.
Hey, Tobin, good to hear from you, sir. As always, Tobin Marcus there of Wolfe Research on the latest state in the race for the White House. Just getting some numbers now from Goldman Sachs, just to share them with you briefly. Net revenue coming in at $12.7 billion US dollars, the estimate $11.77 billion. So that is a big upside surprise. Fixed sales and trading revenue, $2.96 billion, in line with the estimate of $2.96. That stock is higher in the pre-market. We're up by about 2%. Already this morning, we've had numbers from Bank of America, from Goldman. In about 30 minutes' time, we'll get numbers from Citi. We'll recap these numbers in just a moment. Goldman Sachs up in early trading by more than 2%. 2 days of gains on the S&P 500 to close out last week on Friday. Decent day to kick off this week on Monday. Decent day of gains this morning, this Tuesday. Pulling back just a touch on the Nasdaq. We're down by 0.1%. The S&P 500 almost totally unchanged. Let's get to these numbers from Goldman Sachs. And these numbers look pretty good. In a pre-market, a stock is up by more than 2%. It's a beat. It's a beat on revenue, 12.7 billion. The estimate 11.77. Fixed sales and trading revenue in line here, Bramo, but investment banking revenue much better than expected.
And stock trading business, Goldman stock trading business had the best performance going back to the start of 2021. They reported a 45% increase in quarterly profits. Net interest income, $2.6 billion versus the expectation of $1.8 billion. So a really big beat across the board. A real question here, as you talked about this with JP Morgan and the fact that they lowered the bar and then beat the bar. We heard from David Solomon the trading revenues were likely to drop. They beat that bar. They actually rose by 2%. So a similar story here when it comes to some of the performance and some of the previous warnings that turned out maybe not to be true.
So let's talk about those three warnings. So Dan Pinto of JP Morgan warned about net interest income, said that maybe analysts were a little bit too optimistic. Net interest income on Friday looked totally okay. You mentioned David Solomon again, trading totally fine. The other warning was Ally Financial when it came to auto loans and credit there. And I wonder if that's going to be dismissed a little bit later this earnings season too.
That's actually the bigger one because it's a different kind of risk, which is a deteriorating consumer that we have not seen anywhere else. Is it that we're just missing something? And evidently people do have enough worry to still be looking for what they might be missing. And if they are missing anything, Ally Financial and Capital One might have the keys to provide.
Goldman Sachs up in the pre-market. Still with us, Ken Leon of CFRA. Ken, you've had a few moments to go through these numbers. What's not to like relative to expectations looking at Goldman this morning?
Yeah, we went to a strong buy from buy a couple of weeks ago. And I think for investors, it's what's next. And what's next is the following. We had very strong results today, but that's mostly driven by the U.S. markets. Still, this Goldman Sachs is a global bank, but they're getting 75% of their revenue or so from the U.S. So there's opportunity if Europe gets a little bit better, what happens in Asia, perhaps China. That's number one. Number two, the equity underwriting surprisingly was stronger than I thought, but it really wasn't IPOs. It was equity intermediaries. And then M&A is lagging. The record area was debt underwriting. So you put it all together, Goldman Sachs has $3.7 trillion of assets under supervision. So it's a large asset manager. That gets to David Solomon talking about recurring durable revenues. They're getting into private equity and private credit. And what we see ahead is really higher risk taking now that everyone knows kind of where rates are going. And of course, they don't have the exposure of the larger banks, because only 14% of their total revenue comes from net interest income. So it's a pretty exciting dynamic. The one thing we didn't talk about, and I looked so hard in the releases, is what are they doing with the failed consumers' assets that they still have? Earlier today, it's expected that the General Motors credit card that Goldman was operating goes to Barclays. The bigger one was with Apple. But I didn't see it in the release. That question will come up from the analysts.
So, Ken, there's a ton to unpack there. There's a piece of that puzzle that I want to just focus on just for a moment going into 2025. RBC's Laurie Calvasini was with us around the table earlier on this week, and she made the point that a lot of businesses are waiting for the election to clear before they start making some big decisions. We've seen M&A be held back for very specific reasons down in Washington, D.C. The IPO pipeline hasn't been great. Ken, do you see that improving in 25, and is there good reason to expect it to?
No, I think you're absolutely right. And certainly, you run for bonuses if you're an investment banker starting in September. But I think the tone is the election creates a stall. But I think CEOs, as they look at what they want to do for next year, and as it comes into either capital raising or M&A, they're really looking to see, well, what will be that environment? They know kind of where it's going for rates and cost of capital, but what does it mean in Washington? So I think we're not going to be in a high risk on environment. But last year, we hit the trough in terms of investment banking, and I see an upward view for next year. That's positive for Goldman Sachs.
Ken, there are a number of different aspects to this story. The reason why we haven't seen IPOs pick up to the same degree, and part of it has to do with something else you alluded to, which is the increasing dominance of private credit and private equity. You mentioned that Goldman Sachs really beat on the debt underwriting. We saw a miss with the debt underwriting of Bank of America. How are the different banks handling and either benefiting from or suffering from, losing market share from, this increasing dominance of the big private equity and private debt players?
I think to your question, it's really private credit. And Jamie Dimon now every quarter speaks to it. It works brilliantly for smart firms that I cover, like Blackstone, Apollo, Ares. But what happens when you have systemic risk or something goes wrong? We're seeing, it's an old term I use, co-opetition, which means that the firms I just mentioned do work with the JP Morgans or the Goldmans as perhaps sometimes funding them in the transactions, but additionally, they are competing. And the one term that you would hear for 20 years as a bank analyst is the growth of bank syndicate loans. We're not really hearing that anymore, and that's what the commercial banks have to do when you're looking at deal sizes of loans over $1 billion. The private credit business is operating into those areas, moving from middle market to larger transactions. I like it. I think private credit is great because, as Apollo says, we don't want the customer. We're just going to look at what the measured risk is and then decide whether we want to invest or not.
I guess to underscore the point here, are some of these big private credit players really taking business away from the big banks? Because it looks like the big banks are doing just fine.
Well, they are, but there's a mismatch of assets and liabilities and duration. We've been through that story for over a year ago, but it's still there. Those assets, secured assets, which have long-term tails. The regional banks really can't hold on to those. So they're going to be parlayed over to the alternative asset managers. And the area where they're all going to compete is in wealth management and retirement. And again, I mentioned these recurring revenue businesses like annuities and insurance. Those are great businesses, and that's where the opportunity, I think, is for all these banks.
Hey, Ken, it's good to hear from you. Ken Leon there of CFRA. Look at these moves in the pre-market. Let's get that board up on the screen once again. Big shift higher on Goldman Sachs in the pre-market, up by something like 3%. Nice move as well on Bank of America. Numbers from them a little bit earlier this morning. We'll get Citi in about 23 minutes' time. Citi at the moment up another 1%. We had some big moves on Friday off the back of what we saw from Wells and JP Morgan. Those moves continue this morning off the back of these numbers too.
With beats across the board, and it comes to net interest income, it also comes to wealth management and what's going on there. It also has to do with trading revenues. I keep going back to the idea that the bar was lowered, and then they handily kicked over that line. Was there something that they were seeing that somehow changed in the past couple of weeks, or is it just that they were trying to gauge people's sentiment so that they could look good?
I think there's certainly a big dose of that. I think when it comes to net interest income, 2025 is still a bit of a mystery. Looking for guidance there, particularly with the Fed's rate path still pretty uncertain. We spend the whole show discussing that most days, what's going to happen with Federal Reserve policy. They don't know the answer to that either. You brought up a big structural issue that I think is really important. We heard this conversation with Mark Rowan of Apollo just a couple of weeks ago, and Mark made the point that fewer companies are going to go public, and we're seeing that already. There's some big structural headwinds to the story in investment banking. Things are changing. Private credit's a big piece of that, and I'd say the regulatory headline is another big piece of the puzzle when it comes to mergers and acquisitions, and I don't think it's going to be too different based on what we've heard from one campaign to the other as we have this race for the White House this year.
Well, not if you look at how the FTC is currently operating under Lena Khan, who we have seen Trump's running mate, J.D. Vance, talk about her, how she's potentially one individual in the Biden administration he actually agrees with. Regulatory, when it comes to just big banks, big tech, this is something that both camps are looking to really needle at.
Certainly a decent morning for Goldman so far, that's for sure. Under surveillance this morning, Goldman Sachs rising in the pre-market as bank earnings continue to roll in. The bank beating third quarter net revenue and net interest income. Results from Citi still ahead at 8 a.m. Eastern Time. That's about 21 minutes away. That stock is higher by 3.7%. Elsewhere, Nvidia coming into Tuesday at record highs. Shares boosted by continuing demand for its Blackwell chips. The CEO, Jensen Huang, reassuring investors that product delays have been smoothed over. Things are improving.
What I find fascinating is that the shares are up even with some of the concerns around limits on how much the U.S. can export in terms of semiconductor chips. To put this into perspective, NVIDIA shares are up almost 14% this month. We're like not even halfway through. Okay, today we're halfway through. Halfway through the month, they're up 14%, 2.4% gain yesterday. A real question of whether we are actually even underpricing a story that has been one of the main drivers of returns so far this year.
Already, the Biden administration has some of these controls or these caps on about 40 countries throughout the world when it comes to NVIDIA. But the demand is so insatiable, it doesn't matter. You could put more countries on that list. You can cap more of this. There is massive demand just right here in the United States. NVIDIA making another move in the pre-market today. Look out for that rally. More on that story, 8:15 Eastern. We'll have a conversation about that single name and a rally we've seen so far. I want to turn to this slightly controversial story on Tesla. Reportedly remotely controlled some of their capabilities of its Optimus robot prototypes at its showcase event just last week. Sources telling us here at Bloomberg that while the robots were able to walk without external control, employees stationed elsewhere oversaw many of the interactions between the machines and attendees. Not clear how much progress we've actually made.
I love this story. It reminds me of The Wizard of Oz, when you sort of pull back the curtain and there's a guy there kind of operating all these different steam engines. There's a question here about whether this is actually ready to go or whether this is maybe looking like more of a promise. And Elon Musk has a history of making big promises with ambitious timelines. Even he has conceded that. And so it really raises a question, since that was the star of the event, a lot of people said.
What can it do, Musk said? It could be a teacher, babysit your kids, it can walk your dog, mow your lawn, get the groceries, just be your friend, serve drinks, whatever you can think of, it will do. He was talking about the robot. I will say that knowing that, to your point, like the Wizard of Oz, the humans basically controlling what it was doing behind the scenes, it gives his whole title of the event, We Robot, a whole new meaning. Yes, we, as in humans, are controlling the robots.
Someone behind the curtain, literally, as you said.
Yeah.
Controlling things, making your dinner.
Yeah, well, I mean, you know what?
A Tesla employee.
I actually am okay with that. If a Tesla employee wants to come make me dinner with a robot.
Remote controls the factory robot, yeah.
I'm okay. It depends on if you're a good chef or not. But, you know, we could discuss.
We can have that discussion. Depends what they can cook, Bramo. What they're programmed for. That depends on the subscription and what you're willing to pay. It's all subscription-based, of course.
Can you imagine?
Yeah.
Sort of like the Applebee's base.
One recurring revenue, don't you?
Versus the, you know.
How much have you spent on your software for your robot versus to the house next door, you know?
And that depends on how well they cook. Actually,
exactly.
That would be brilliant.
There you go.
I would get into
It's the future of chefs and Michelin star.
Exactly. Saturday night is the new
Michelin's going to rate your robot. Let's get you an update on stories elsewhere before this goes too far. Let's get your Bloomberg brief with Danny Berger. Here's Danny. Hey, Danny.
Hey, John. J&J shares down by about 1% this morning. It did report stronger than expected third quarter earnings. That beat was driven by surging sales of its cancer drug, Darzalex. However, J&J lowered its full year guidance to account for a medical device acquisition. CFO Joe Walk said that they are still seeking smaller tuck-in deals, but also remain open to larger acquisitions. On the other side of things, Ericsson shares surging to their highest level in 2 years, up about 11.5% over the past 3 days, after its deal with AT&T helped push third quarter earnings above analyst estimates. North American sales for the telecom equipment company grew by 55% year over year. Sales in Europe also saw growth despite facing a challenged market for network technology. Tensions between Canada and India are escalating. Prime Minister Justin Trudeau accused Indian diplomats of backing criminal harassment against Canadians. It compounds a dispute that began last year when Trudeau suggested that Indian agents were involved in the murder of a Canadian Sikh activist. Canada expelled 6 officials yesterday. It said India refused to waive their diplomatic immunity for questioning over a number of violent incidents. India has rebuked Canada and expelled 6 of its senior diplomats in response. And that's your brief, John.
Danny, appreciate it. More from Danny again in about 30 minutes' time. Up next on the program, crude uncertainty.
These attacks have claimed the lives of many Israelis, including yesterday. Israel has every right to defend itself against Hezbollah and will continue to do so.
That conversation up next, live from New York this morning. Good morning. Goldman Sachs in yesterday's session closing at all-time highs, even before this move this morning. Year to date, that stock was up by more than 35%. That is where the outperformance has been from the big banks on Wall Street. Goldman up again this morning by 3.4%. Bramo, it's another big meet.
And a lot of it has to do with net interest income pretty much across the board. Net interest income for Goldman Sachs came in at $2.6 billion versus the expectation of $1.8 billion. It is a good and beautiful thing for these banks when you have a disinverted yield curve, and that is what you're seeing in all the results.
Upside surprise on Bank of America as well earlier this morning. That stock is up by 2.4%. You'll get numbers from Citi in about 13 minutes' time. Under surveillance this morning, crude, uncertainty.
Israel is not fighting UNIFIL. It's not fighting the people of Lebanon. It is fighting Iran's proxy Hezbollah, which uses Lebanese territory to attack Israel. Hezbollah attacked Israel last year without any provocation on October 8th, a day after the Hamas massacre. And it's continued to attack us ever since by launching over 10,000 rockets and missiles at Israel. These attacks have claimed the lives of many Israelis, including yesterday. Israel has every right to defend itself against Hezbollah and will continue to do so.
So here's the latest. Oil extending losses on a report that Israel may avoid targeting Iran's energy facilities to limit potential escalation, easing market concerns of a major supply disruption. In a statement, Netanyahu's office said, "We listen to the opinions of the United States, but we will make our final decisions based on our national interests." Stephen Cook of CFR joins us around a table for more. Stephen, good morning.
Good morning.
Do you buy the reporting from the Washington Post? Do you believe that maybe he will pull back and won't go for energy infrastructure in Iran?
Maybe. I don't really put a lot of stock into the Washington Post reporting, if only because these discussions with Israel have been going on for a long time throughout this conflict. And every time the United States believes they have the Netanyahu government in a position where they're agreed, the Israeli government does exactly what Prime Minister Netanyahu said in that statement, that the ultimate decision is up to the Israeli government. So it will be anybody's guess until those planes or missiles are in the air what those targets are.
If this is accurate, though, what is the United States and what is Israel getting in return?
Well, the Israelis are getting the THAAD anti-missile system, which is an incentive for the Israelis not to hit Iran's energy or nuclear infrastructure. The clear fear is if the Israelis go way up the escalation ladder and go after those very symbolic and important sites, the Iranians will respond in kind. And that's precisely what the Iranians have said. The United States would like for this to be an Israeli response and then the end of it. The THAAD is a way to both incentivize the Israelis to avoid those sites as well as to protect Israel from another Iranian strike.
This is a really important piece of technology. It was only deployed to Israel once, and that was just for operational purposes in 2019. They've never actually used it. Wouldn't the THAAD be enough for Israel to maybe agree with Washington in terms of their retaliation?
That is clearly the hope of the Biden administration. But again, throughout, a number of weeks ago, the Biden administration thought that the Israelis had agreed to a ceasefire in Lebanon when the Israelis actually escalated. So once again, we have to listen very carefully to what Prime Minister Netanyahu and his advisors say, which is ultimately the decision is up to us based on our own security. And this has been a tension in the U.S.-Israel relationship. The United States has broader concerns, whereas Israel has very, very specific concerns about its security and its adversaries.
They have specific concerns, but at this moment, do they know where it is going?
Well, that really is the biggest question. What is the overall Israeli strategy here? And I think the overall Israeli strategy, although people say, it's a mystery and whatever, is to reestablish Israel's deterrence. They're having actually a hard time doing that. They have been pounding Gaza for a year, yet rockets still fly from Gaza occasionally into Israeli population centers. Israeli forces have to go back into sections of Gaza to fight. They engaged in a number of stunning intelligence operations in Lebanon just a few weeks ago, pushed Hezbollah back on its heels. Yet, since the killing of Hassan Nasrallah, the leader of Hezbollah, I count somewhere in the neighborhood of 2,000 rocket attacks on Israel. Israeli forces are operating throughout southern Lebanon to try to suppress this and secure their border, but they haven't done it.
Given your historical knowledge, where we are right now in this conflict, is it the start of a more longer protracted conflict? I think of where the United States was when they went into Iraq. This is at this point in that time basically decimating the Iraqi military, decimating Saddam Hussein and all of his acolytes. But that conflict dragged on for years. Where are we?
I think this conflict is going to drag on for years as well. Just think about Gaza. The Israelis have no one to hand Gaza off to, so they have to keep going back into parts of Gaza where Hamas reconstitutes itself. Think about a security belt in southern Lebanon. The Israelis had one between 1985 and 2000. They don't have any partners to hand it off to. You can't count on UN peacekeepers. You can't count on the Lebanese armed forces. The Israelis are dealing with a situation where they have to decide on what is the least worst option for them. And right now, it seems they're left to having an extended, grinding counterterrorism operations, both in the south and the north.
You said that the U.S. has a different aim than Israel, that the U.S. wants a more contained and limited kind of strike. Is it just simply because of oil prices, or is it something bigger?
Well, it's clear that the United States doesn't want a regional war because that would affect regional oil prices. But there's also a question of regional security. If there is a larger war between Israel and Iran, it could involve Saudi Arabia and the UAE, which are both extremely vulnerable to Iran's missile forces.
The reason why I ask this is because you think about the Houthis attacking some of the shipping resources. You think about some of these other threats that have raised concerns among the U.S. as well as Saudi Arabia and the UAE. Where would they stand if this conflict were to escalate?
Yeah, I think that ultimately, if it were to escalate, they would close ranks with the United States. But the Saudis and the Emiratis are angry at the United States for not heeding their warnings for about a decade about the Houthis. And now we're dealing with a much greater Houthi threat than when they first started warning about it.
We had a market guest, an investor on this program in the last week or so, who suggested that maybe there was a vacuum of leadership right now, waiting for the election result, and that foreign actors could possibly take advantage. How do you view that situation?
Well, I think it's clear, particularly when it comes to what the Israelis are wanting to do and what we started talking about, is that we're 3 weeks to an election and then there'll be a transition. It sort of gives leaders a free hand to do things. If Netanyahu decides and the security cabinet decides that hitting the oil infrastructure and the nuclear program are in Israel's best interest, the president of the United States is only going to be around for a shorter period of time, so that they essentially have a free hand to do what they want.
Do you think it gets more or less dangerous when we get to November, between November and late January?
Oh, I think that we are in an extraordinarily dangerous period right now, with the Israelis contemplating a major strike on Iran and the Iranians promising that they have no red lines, that they will respond in a very serious way to the Israelis, thus the THAAD.
Given how many things this White House has got wrong over the last 3.5 years, are you surprised that the same people are going to finish this administration as start it? Are you surprised that Jake Sullivan's still there, Finer's still there, Blinken's still there? They've been there the whole time and made mistake after mistake. Where is the accountability in this administration?
Yeah, look, the Middle East is extremely, extremely difficult.
Of course.
No doubt about it. But yes, I think that the administration, and particularly the person of the president, made a number of miscalculations at the outset of this conflict. There has been the idea that a hug of Prime Minister Netanyahu would give him leverage over Israel's military operations. There was also the belief that a new relationship with Iran was possible, rather than understanding the fact that the Iranians were willing to have limited agreements in one realm while sowing chaos in other dimensions.
Stephen Cook of CFRA, appreciate it, sir, as always. I think we all remember that conversation. Was it Jake Sullivan? Right before the events of early October, that tragic terrorist attack and the war that ultimately came afterwards, saying that it's as peaceful as it's ever been over the last few decades.
Yeah, saying the region's been the most peaceful. That went online as such, or into written copy, and then they were able to edit it online. But those words were still there. And then almost just recently, we saw the same happen with Secretary of State Antony Blinken.
Amazing. Coming up on this program in the next hour, Stephen Auth of Federated Hermes, William Stein of Truist Securities, Kathy Bostjancic of Nationwide, and Vishal Khanduja of Morgan Stanley. From New York, this is Bloomberg.
There's a lot of potential earnings upside ahead.
The health of the stock market's going to depend on earnings.
You do need to see earnings estimates continue to rise, we think, in order to support the market.
We're going to see solid but not blockbuster revenue growth in the third quarter.
Earnings need to do a lot more heavy lifting as we turn the corner into 25.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Coming into Tuesday at all-time highs on the S&P 500. The opening bell 90 minutes away. Equity futures on the S&P 500 just about unchanged throughout the morning. Likewise on the Nasdaq. The Nasdaq 100 right now negative by just 0.04%. Elsewhere, some decent gains, and I'm talking about some big moves in the banking sector. It's been upside surprise after upside surprise throughout the morning. First of all, it was Bank of America. Upside surprise. Stock is higher by 2.6%. Goldman followed. Same story. We're up by 3% in the pre-market. Citi, just seconds ago, markets revenue 4.82 billion, the estimate 4.6. Bramo, an upside surprise.
And pretty much it's across the board. If you look at fixed income, commodities and currency sales and trading, also beating at 3.58 billion versus the estimate 3.4 billion. You could take a look at markets revenue coming in above estimates. As John, you just mentioned, equity sales and trading coming in at 1.25 billion versus the estimate of just north of 1 billion. Basically across the board, a couple of hiccups here and there, but just underscoring how much strength there is right now in the banking sector as they face off with an economy that's just fine, a consumer that's chugging along and spending, and net interest income that's coming in bigger than expected simply because, if nothing else, the yield curve has disinverted.
You nailed it, the word strength. You take out a nugget from what Goldman's boss, David Solomon, is saying in his statement. Strength is in the first sentence of his statement to shareholders, and, quote, strengths, plural, is in the second sentence. There is no third sentence. That is where they're banks right now, and they're feeling very good. No major drama. I'm interested in what the CEOs have to say about other things happening in the world. Jamie Dimon talked about this on Friday, the geopolitical uncertainty and what that could mean to the global economy.
Look out for the calls throughout this morning. That stock is edging higher, just inching higher just a little bit in the pre-market. Coming up this hour, here's the lineup for you. Stephen Auth of Federated as banks deliver better than expected results. William Stein of Truist as Nvidia rallies back to record highs. And Kathy Bostjancic of Nationwide looking ahead to some messy data. We begin this hour with stocks at all-time highs, lifted by tech as investors stay optimistic about the start of earnings season. Stephen Auth of Federated remaining cautious, writing bull markets are known for climbing walls of worry. So in some ways, the present batch of uncertainties is not unusual. However, with the market already less than 5% away from our 2025 6K target on the S&P, investors can afford to be measured here. Steve joins us now for more. Steve, good morning.
Good morning, Jonathan.
Decent run for the banks. Backed
Absolutely.
up by the earnings too. Are you encouraged by what you see?
Very important. You got the banks are the big hunk of the value indices where we're overweight, and we're telling people that's where they should be. And this is what we've needed to see. Once you disinvert the yield curve, what's going to happen is rates are coming down. It's helping the banks because it's disinverting the curve. It's not helping. You keep bringing up the idea that, gee, these rates are coming down. That should be, if they don't come down, that should be bad for tech. The 10-year yield, we think, is probably going to stabilize here, as you pointed out, Lisa, between 3.5 to 4. It's not probably coming down. The curve is disinverting. The 10-year matters for the tech stocks. The curve matters for the value stocks, the bank stocks, and that's what we're seeing. We're seeing the earnings coming through there, and they're trading at 16 times. Large cap growth indices are trading at 28 times. So the gap is quite substantial on both where the earnings growth is heading and where the valuations are.
There's a lot to unpack there. There's an idea of the banks as a litmus test for the rest of the value sector, basically a litmus test on how much this is an economy that's reaccelerating or really in the mid-cycle or early cycle of another bull market. And I'm wondering whether that's actually accurate, whether these banks truly are a reflection of that, or whether they're telling a somewhat different story than what we might hear from the Ally Financials, from the Capital Ones, from the regional banks.
Well, Allied Financial is telling you, I think, we've kind of cut that to pieces, but, it's telling you that the low-end consumer is in trouble, right? Their problem was on, the car loans for the low-end consumer. Okay, that's where there's weakness in the economy. And we see that throughout the stock market. But the rest of the economy seems to be being okay. I wouldn't say re-accelerating. We're more in the line of it's landing. We had a little bit of a soft patch, so maybe re-accelerating off of August. But we see it as landing, and that should be good enough for a lot of the stocks in the value sector. I mean, I'm not recommending buy the whole index here. I think it's a kind of a stock-picking game there. But
you sound cautious, optimistic, but not necessarily, hair on fire, let's go buy everything because it's going to be amazing. Why the caution?
Just because we've had a huge move, when we set our target of 6,000 back a year ago for 2025, people thought we were a little bit nuts. I mean, at that time, we were going to head in a recession, next week at 3:30. Everybody knew it. And we said, look, we think we can get to $300 in earnings by 2025 on the S&P, which sounded like a big number, but on a nominal basis, given how much the inflation has driven up nominal GDP, we thought we could get there. We're still at 300. We think a 20 multiple kind of works. We've always thought inflation was going to stabilize around 2.5%, not quite at the Fed's target, but I would call it their informal target. If you're at 2.5% on inflation, you're probably at 3 at the Fed funds rate, and you're probably at 4 on the 10-year because you're going to reestablish a term premium. Long-term bond investors have figured out, oh my goodness, we can actually lose 20% in a year. So they're going to want their term premium back. So we've been pricing stocks against a 3.5 to 4% 10-year yield. And when you look at historically where that should be, about an 18 multiple on stocks. Okay, in the interest of being a little more aggressive, we use a 20 multiple. So 20 times 300 in 2026, which you discount back at the end of 25, well, I don't need my summer intern to tell me that's 6,000.
But going back to Lisa's point about these concerns, you write in your own note, bull markets are known for climbing walls of worry, and you outline 5 uncertainties that you really need to tie a bow around in order for this bull market to continue. Yeah. What makes you the most nervous? I'm actually thinking about writing a piece soon called, 4 out of 5 ain't bad. I wrote a piece over the summer called 1.5 out of 3 ain't bad. But these things are clipping away here, right? The earnings numbers needed to come in first and foremost. Now, let's see how the rest of the season goes. But the banks, which were a big piece of our idea, they're showing strength. That's good. Then you got to get the inflation numbers not to reaccelerate. That's a little bit dicey here, but we still think we're heading for like a 2.5. The PPI was sort of a 2.5, let's call it. So the inflation numbers need to stabilize, but maybe a little higher than the market wants, but we think good enough. Then the Fed needs to indicate not so much the pace, but that they're going to get to the levels we're talking about. All they've got to do is get to 3% on the Fed funds rate, and the rest of the story falls into place. We have a Fed meeting on November 7th. That'll be a big one, just to see the tone of that. If things keep going the way they're going, they probably don't even cut there. But it depends on the tone of the press conference, right? And then you need China to finally kick in. We're seeing that. They're attacking now at a simultaneous level, both Fed fiscal policy and monetary. We think that package could be $5 trillion that we're looking at, which would be an upside surprise. And then you need the election to fall into place to help the value trade, because I've always said this, the election is about value versus growth in some ways. I mean, not so much the market overall, but President Trump would be far better for the old economy stocks, if you look at his policy agenda. So in a way, that just adds fuel to the fire. And right at the moment, it seems like we're heading in that direction. So fall in place for you is a Trump victory?
For the kind of the value small cap trade that we've got in place. We think if you look at his policy agenda, deregulation as an example, that helps smaller companies that don't have the wherewithal to pay all the costs of regulation. Lower high-income tax brackets, which affect all the small company businesses that file in that fashion. The tariff agenda, which is probably a negotiating one, but certainly probably helps the old economy industrial stocks, a lot of those in the value space. So the Trump agenda is primarily oriented, in our idea, towards more of this value trade. And if that comes into place, that just adds fuel to other existing fires that help that trade.
So if you do get a sense of who wins, then you will be much more aggressive with the trade. Is that basically, are you waiting with some cash to basically figure out whether you're going to put it one way or another, depending on November 5th?
Our old friend Tom Keene, right, always has that cash money market fund.
Triple leverage.
Triple leverage.
Get in it, I'm telling you.
We've got 2 on the sidelines, 2 points out of 10 in money markets. We're earning 4 or 5% on that, which is not bad right now. But that's going to go back into the market, maybe when we get to 4 out of 5. It might be before the election. You got to watch the polls here, but they're going in a direction that might cause you to probably. The market's going to try to discount all this stuff in advance. So if you're too cute and try to wait for everything to fall into place.
That begs the question, are you being too cute?
I might be.
Are you worried about that? Stocks at all-time highs, credit at multi-decade tights.
We're still overweight stocks, so we're hanging in there. Okay.
Cautiously bullish.
Yeah. And I guess I'm probably waiting to see maybe if the large cap tech stocks can live up to expectations, other than NVIDIA. NVIDIA's making a boatload, not going to argue there, but the rest of them are paying money to NVIDIA, and they've got to actually show that they can make money. That might cause some softness in the market.
Steve, it's good to see you.
Likewise.
When you get to 5 out of 5, come back.
I'll give you a call.
Good. Stephen Auth there, at Federated on the latest. We got Citi numbers just moments ago. Citi up in the pre-market. We've had a decent run of gains for bank stocks over the last week or so. It started with JP Morgan and Wells Fargo on Friday. And this morning, it continued. We heard from Bank of America. We heard from Citi and Goldman Sachs, all looking pretty good. Let's cross over to Ken Leon of CFRA. Ken, Jane Fraser overseeing and delivering a multi-year transformation at this bank. How's it going?
That's right. And I think it's continuing. I mean, there's milestones ahead. They still have to sell off next year their largest non-U.S. consumer bank in Mexico. Additionally, they already had the mark of reducing headcount by 20,000. And we'll get some progress on that and just managing operating costs. Rates are important because 74% of their total net revenue comes from net interest income. They have a lot of good businesses that have durable recurring fees and treasury services and payments. I think Citi looked okay. And then kind of the takeaway from the large banks dealing with the consumer is that the NCLs, or the non-performing credit loans, are in that 3.5 to 3.7% ratio to total loans. So it's those are pretty good, even for all the bank analysts. And I think to the earlier discussion here, the banks are holding their weight in and give us a bullish view with an overweighting of the financial sector. There's about 12 stocks that represent 65% of the financial sector. 4 of the big banks are there, but you got quality in this group with the Visa, MasterCard, American Express, S&P Global, Berkshire Hathaway. But I'm relieved. I think the banks are really going to send us off into a more positive 2025 for the fundamental outlook for these large banks. And our analyst who covers the regional banks is also much more constructive than where we were 6 months ago.
So, Ken, just quickly and finally, do you expect more of the same from Morgan Stanley tomorrow?
I think Morgan Stanley is also going to be like Goldman and celebrate how well we're doing in the capital markets, trading, of course, but there's still upside opportunity going into next year for investment banking. That's good for Morgan Stanley. And with the equity markets rising, market values will benefit the largest wealth manager, which is Morgan Stanley.
Ken, good to see you. Thanks for this morning. Ken Leon of CFRA. So far this morning, so far over the last few days, clean sweep for banking in America.
Pretty much across the board beats, and really you can't find many misses. The ones that you do are pretty minor. Big question here about whether this is just a positive read for the financials or a broader positive read on both the consumer as well as just business sectors that were struggling with how high benchmark rates were, seeing them come down, but still seeing their assets perform that are put into longer term debt.
Citi up by about 2%. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Some other earnings for you. United Health shares down 3.4% in the pre-market. It lowered the top end of its forecast, a rarity for the insurance giant, which usually withstands pressures that hurt its peers. Higher medical costs and the rising impact of a cyber attack were behind that guidance downgrade. United Health is often seen as a bellwether for the health insurance sector. Oil prices tumbling, down some 3.9% and 4.2% for Brent and NYMEX crude. Reports that Israel will avoid targeting Iran's crude facilities and its expected retaliation for Iran's missile strike 2 weeks ago. The report is easing investor concerns over what many feared would be a major supply disruption. Israeli Prime Minister Netanyahu told the Biden administration the nation plans instead to target Iran's military. The news also comes as the IA warned this morning that the oil market will face a glut heading into next year. And top U.S. labor official Julie Su has met with leadership at Boeing as the ongoing strike continues to take a heavy toll on the troubled plane maker. Su traveled to Seattle and reportedly urged both sides to move forward in the bargaining process over a new contract. The developments come after the latest talks between Boeing and its largest union broke down last week. Boeing's latest offer was raised to a 30% pay boost over 4 years, which was rejected by union leaders. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next, the morning calls, plus William Stein of Truist as Nvidia shares hit a fresh record high. The conversation up next, live from New York. You're watching Bloomberg TV. If you're just tuning in, welcome to the programme. It's been beat after beat on Wall Street for earnings season so far, and it was no different this morning. We heard from Bank of America, Citi and Goldman Sachs. Upside surprises here, Lisa, across the board.
Yeah, net interest income coming in strong across the board, and I think that's important to really highlight given the fact there was a big question. And we were talking about this extensively. Are high rates good for banks? Are low rates good for banks? And as Steve Auth was just saying, it's the shape of the yield curve, which is not what you really want to hear. But basically, when you have long end pinned at 4% and short end coming down, that's a pretty good time for banks.
That outperformance continues for Goldman. That stock is up by more than 35% so far year to date. It's up another 2.76% so far this morning. Let's get you some morning calls. First up, Goldman Sachs downgrading Etsy to sell, adopting a more selective approach to e-commerce stocks ahead of earnings. That stock is down by 4%. Next up, BMO downgrading American International Group to market perform, citing minimal room for growth and soft pricing power. And finally, Evercore adding Airbnb to its tactical underperform list, recognizing potential for a muted bottom line outlook. Let's turn to tech. Nvidia coming into Tuesday at record highs. William Stein of Truist calling the stock a buy rating. We expect Nvidia's superior positioning in gaming, server acceleration, AI, and eventually autonomous driving will lead to ongoing structural fundamental growth and stock performance. Will joins us now for more. Well, welcome to the program. Let's talk about this buy rating. There's a lot of people that have still missed out on this run. The stock's got to a record. It's up by a ridiculous amount year to date. What's your advice to people who are out of the stock looking to get in? Why is now the right time?
Yeah, I think the first and perhaps most important thing to recognize is to distinguish between, record stock price and valuation. Just because the stock's up a lot doesn't mean that it's expensive. We don't think it is. And we think there are earnings beats still on the come for this company, and it is not expensive relative to growth semis.
How much of this depends on their ability to produce more quickly and also to get some of the updates up and running in a more expedited fashion?
Sure. The company recently transitioned from a 2 or more year cadence in between these AI specialized GPUs to a 1 year cadence. They announced that relatively recently, and they're starting it going forward as they go from the emerging Blackwell generation to the next generation called Rubin. That's when they're going to be on this 1 year cadence. And of course, being on time helps. They are significantly ahead of the competition. In fact, we don't even really view this 1 year cadence as something that's required in order to distinguish NVIDIA from its nearest competitor. It's really about the full stack of technology that the company offers its customers. It's not just these high performance chips, right? We've talked about three things, a culture of incumbency, an ecosystem of incumbency, a culture of innovation, and significant investment in software services, and now pre-trained models is a big part of the company's business as well.
Some people were surprised that given, yes, there's a lot of good and it's all being priced in, or some of it is, you're saying it's not all being priced in, but there is a potential cloud hanging over the stock, and it comes in the way of restrictions by the U.S. government. How do you see, if not necessarily dampening demand, how do you see NVIDIA being challenged or adjusting its business model in response to concerns about national security?
I think it's a super important question, but it is also critical to understand that this company has dealt with these restrictions for a number of years, as have most of the semiconductor companies in the United States. There have been export restrictions, and let me give one example. We spoke with management a few weeks ago. We hosted a bus tour, and NVIDIA was one of the featured companies, and management was talking about sovereign AI as one of the current significant growth drivers, right? These are national level AI models built in countries that might not speak, U.S. English as sort of their main language. So France, other countries in Europe and Asia building their own domestic, or let's say sovereign AI models. And I asked about China, and it was a flat, we're not working with the government of China on this. Let's be clear. These restrictions have been in place for a while. They will continue to be. It's the volatility in what is restricted that's going to challenge not only NVIDIA, but all the companies in this space.
At this moment, though, William, would you say that these restrictions, which you're right, for NVIDIA and for AMD, that's happening in about 40 countries around the world, the United States has these caps, are they narrow at the moment?
Well, they're always changing, right? So it's certainly possible that a new restriction could come into place that could make the company's revenue generation more challenging, right? For years, they've had specific products for China that they've rolled out to address that market while not breaching any of the concerns of the U.S. federal government. I think NVIDIA is going to continue to do that, continue to have a China-specific skew, and new restrictions might make that harder over time. But this market has not been wide open to NVIDIA so I don't think there's massive change coming in this area.
William, appreciate your time this morning. On the stock with a buy rating, William Stein there of Truist. That stock is down by about 0.7%. It's up by almost 180% so far year to date, after gaining the year before by close to 240%. William had a really important distinction. The stock is at a record high. The valuation is not. The earnings have been real over the last year.
Which is the reason why people can justify and say, ultimately, there's no other game in town. That's one thing that he said. Even if they release fewer chips, maybe one a year, they're so far ahead of their competition that it's just hard to see how they're going to lose that share in this race.
The national security concerns are really interesting because this scoop that we have, it remains to be seen whether or not Biden even has enough time to put these kind of caps to the countries in the Persian Gulf they're looking at, say, the United Arab Emirates. Is this something that, obviously, if it's Kamala Harris, it probably would carry through. But if it's the former President Donald Trump, are we looking at this similar type of caps when it comes to these AI companies and their chips?
Quite possibly. NVIDIA right now is down by 0.6%. Up next on the programme, Kathy Bostjancic of Nationwide and Vishal Khanduja of Morgan Stanley Investment Management on the data and the bond market. That's up next on the programme as we count you down to retail sales a few days away from New York. This is Bloomberg. Minutes away from the opening bell, equity futures on the S&P 500 totally unchanged. Plenty of action beneath the surface as we count you down to the opening bell. Let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Just digging into some of the earnings bonanza. Really strong showing from Schwab. Shares up more than 8.5%. It is the benefit of lower rates and a booming equity market. New client assets up by 27%. That helped them beat on their EPS 77 cents versus 75 expected. Also helped them write down some costly debt. Another mover to the upside after earnings. It is Walgreens Boots reporting that they will will be closing less stores than expected over the next 3 years. 1,200 stores before they said it would be 2,000. Closing stores, immediate boost. But again, not as bad as feared, up 4%. But just for some context for the stock, it's down 65% year to date. So maybe a low bar for them. The CEO saying that they still have more challenges ahead for the rest of the year. Speaking of low bars and being able to beat them, the banking sector. Here are the three major ones that reported today. Citi, Goldman, Bank of America, all up at least 2%. One of the stars of the show for all three of them was trading. Trading results really strong. Goldman Sachs, their best equity trading quarter since 2021. For Citi, it was their best third quarter trading results since at least a decade. Net interest income, that also fell, but wasn't as bad as expected. So, John, for the banks, the good times keep on rolling.
Danny, they do. Thank you very much. And you'd have to imagine it's a pretty high bar for Morgan Stanley tomorrow after all these numbers this morning.
Especially because Goldman Sachs and Morgan Stanley are in this tit for tat who can actually outperform the other ones. So for Morgan Stanley, they need to come out and show that not only are they beating when it comes to net interest income, but that their wealth management unit really is outperforming, because that is the engine a lot of people are looking for there.
That's one for tomorrow morning. Markets also looking ahead to the big data point of the week, retail sales on Thursday. Kathy Bostjancic of Nationwide expecting September's print to come in relatively flat. Also anticipating some idiosyncratic impacts thanks to Hurricane Helene. Kathy, welcome to the programme. I want to get to the words of Governor Waller, who suggested that maybe we could see 100K subtracted off October payrolls because of the strike at Boeing, because of the hurricane impact as well. Can you put a number on it, or is it still too early?
Well, good morning, John. Well, we know that, in the past, right, there's been disruption, to employment, to production, could also skew higher, prices of construction and used car prices, things like that. It is always difficult to precisely get a handle or estimate ahead of time, but I think it's fair to say it's at least 100,000 or so off of this. Historically, it has been in that range, 50,000 to 100,000, depressing payrolls. And the problem is it comes at a time where it's messy, right, for the Fed. They'd like to get as much clarity as possible on the incoming employment readings, and this just makes it difficult to get that clear view.
So, Kathy, Governor Waller acknowledged this in the speech. The next couple of lines, he talked about this data dropping in the quiet period and how they wouldn't be able to explain to people what was actually going on. Do you see a big mission, a campaign effort now from the Fed officials for the next few weeks to explain how weak this number might be and how little it might mean for the decision they make on November 7th?
I think that makes sense, that, especially with Governor Waller starting that discussion. I think that makes a lot of sense. I'm also a little bit concerned about this messages being sent during the blackout period. Maybe they need to shorten the blackout period. That's another discussion. But I do think that's true. And you're going to see that with it in production data as well, and jobless claims. We saw that increase last week. That's probably going to increase another, above the normal trend. And we're going to see it in specific states as well.
What I find interesting is that everybody's looking at an explanation for why the Fed won't be more aggressive with rate cuts, but no one's thinking, oh, maybe they're not going to cut rates at all, even though we saw an upside surprise when it came to inflation. Why was the upside surprise not a big deal in any way, shape, or form for all the people talking about further rate cuts of the likelihood of probably 50 basis points by year end?
Yeah, it's it is just 1 month's data. And I think within that report, there were a lot of idiosyncratic measures where we saw increases, which we don't think will continue. Like apparel was up over 1%. You also saw, odd things like sporting event cost up, 10%, 11% on 1 month. Those aren't repeatable. And the overall trend that we look at still looks encouraging, and particularly because we saw shelter costs start to cool down, and we think that will continue to be the case. But it certainly should raise some doubts of whether they will go into November, December. We would agree with that. It's not a sure bet or slam dunk, but we still, in our baseline, look for 2 25 basis point rate cuts. And it's really because policy is still very restrictive at this point. And the Fed has told us, and rightfully so, they want to get back to a neutral rate to help nurture, continued expansion.
I want to pick up on what you just said, Kathy, that it's clear that we are currently in a very restrictive state of monetary policy. There were some doubts raised about that by Neil Kashkari, basically saying the extent to which the interest rate policy was restrictive is, quote, unclear. He was speaking yesterday at an event in Argentina. Chris Waller talking about how it is important to move toward neutral, but we haven't gotten that clarity from the Fed. Is there a precedent of this lack of clarity when it comes to even the range of potential neutral rates that we could be heading toward?
Well, I think it's refreshing and certainly a bit more transparent in the sense that you never really know what the neutral rate is, and you have your models, you have the Taylor rule that you could use. And you could also observe the incoming data. And that's what they're trying to do is put all of that together. And they really don't know. And then there's a long run neutral rate, and then there's like a current neutral rate. And they really want to kind of guide to both of those. So when there's a lot of uncertainty, and this has been mentioned before by other Fed officials, they go slowly. It's, you're walking around in a dark room. You don't want to trip or knock something over. So you kind of feel your way carefully. And I think that makes sense. But I think by all measures, policy is still very restrictive. You just have to look at the very interest rate sensitive sectors of the economy, with just housing and also autos. And then you look at how much of economic pain the lower income and middle income households are facing. And you can see that rates are too high right now where we are. Now, does it mean that they need to, go more carefully? We're certainly not going to go 50 again. Do they pause? Well, I don't know if they would pause right now, but maybe that pause comes sometime in 2025 in the early part of the year.
Well, we heard from Waller talking about what the impact the hurricane might have on jobs. Kathy, we have retail sales this week. What will the hurricane have in the impact when it comes to those numbers?
Yeah, I think for the month of September, not as much, but you could see some tailing off. You could see in some of the credit card data, there's been a little less spending, especially in the states that are affected. But overall, I don't look for a big impact in the national number. I think there'll be some, but it'll be pretty small. I think it's more the October data where we're going to see a larger impact. And that could just range, particularly in the consumer sector, but it could range also for businesses as well, spending, production, output.
Kathy, appreciate the update as always. Kathy Bostjancic there of Nationwide on the incoming data. Retail sales coming on Thursday, 8:30 Eastern Time. With us around the table, Vishal Khanduja of Morgan Stanley Investment Management. Vishal, good morning. It's good to see you.
Morning.
We've just had a big month of global easing, which you've recognised yourself. We've had a Federal Reserve cut by 50 basis points. We've had China begin to take on more of an easing posture. Is that a reason to buy bonds or sell them?
I think after the reset, absolutely buy them. I think at 250 basis points till 2025, I think it was a tough slog there, and we were backing away from it. At this point, I think we think it's fair value at this point. But I think the market is getting a little bit carried away with the stimulus, as you pointed out, as well as the one or two good data points that have come out. It doesn't change the trend for us.
Well, tell me what the trend is for you, because it's been very confusing for the rest of us. We've seen contradictory data across the board when it comes to the jobs market. You can pick out the employment components of the ISM, weak, the labour differential, not great and getting worse. Or you could look to headline payrolls in America and just say everything's OK, unemployment's still close to 4%. What is it to worry about? What's the trend for you?
Disinflation is very intact for us. I think Kathy mentioned in the previous slot as well. I think the data points that we are getting within inflation, definitely the ones that are a little bit more volatile are showing up, which we don't think are going to persist for a long time. OER, big component of shelter, is going to drop off, as at least from the indicators that we track. So disinflation is very intact. Economy is still in that exuberant / soft landing phase. So you see the growth perk up from time and again. Labor market being one component of that. We don't think that these cuts that they've announced or they've started off with 50 basis points are anything to resuscitate an economy which is going into a recession. So these are recalibration cuts. They've used that word very, very clearly as well.
Pause. An economy that's going into recession. What signs are we seeing of any potential recession anywhere on the horizon based on everything that everyone's saying, these companies included, about how strong the consumer is?
I think narrative shifts are so severe, and we've seen that since 2022. I think we saw the 250 basis points priced in with two really tough NFP reports where we started to question whether these are because of labor pool increasing or people coming into the job force, or this is because of layoffs. And then I think the market got very tied up with that for probably about 2.5 months. And now we are coming back into it with one very, very strong labor report that comes out. So yes, consumer is strong. Underneath, balance sheets are very strong. We invest in balance sheets. We have bondholders. One quick point also I would raise is this is the issue that we will have if a big chunk of the economy is interest rate insensitive, which is because of the stimulus that you put in, and then you ensued a very low interest rate environment where all of us refinanced at 3% 30-year fixed. Very similar to what Comcast.
You say all of us. All of us wish we had done that. Not all of us did.
Some of us did. And
some of us did, and one's around this table and very happy about it.
And some people are pretty bitter about it. But I am wondering, you actually are seeing a tick up in mortgage, at least for financings, as a result of how much things are coming down. The world that you're talking about, with this binary risk of narrative shifts, doesn't speak to a world where credit should be holding in as much as it is. Wouldn't you think if there was a risk that, in particular, high-yield bonds should be just ticking up, showing a little bit of a sign of concern rather than absolutely cratering when it comes to the extra spread that investors demand to own over benchmark rates?
Very fair. We are trying to demand a little bit, and we are getting priced out. So we are at the lowest point of high yield in our portfolios for that one reason. I think if we slot it in the way of how we look at the world, fundamentals, technicals, valuations, fundamentals are strong. You can take a few companies out of that picture who are idiosyncratically going through issues right now. Technicals are fiercely strong, and that is less of a spread buyer, more of a yield buyer that is coming into the market. Real yields are high, and yields are best predictor of total returns analyzed for the next 3 years.
When we look at spreads and spreads exclusively, and we compare them to a different period, and we say they are just as tight as they were back then, multi-decade tight, how different is the index now versus, say, pre-GFC? How different is this one?
Much cleaner. Balance sheets are much, much stronger. Even if growth flatlines from here at 1% to 2% real GDP, I think we will be just fine. As coming back to that homeowner example, I think a lot of balance sheets can have connotations.
So can I just ask an additional question?
Please.
And I know it's difficult, and I don't expect you to have a precise answer, but typically, historically, 300 basis points, 250 on high yield is super, super tight. Do we need to rethink that? Is the new number like 200, 150? What is it?
Could be, absolutely could be, if CCCs continue the carnage that they've been on probably over the last 2.5 months here. Idiosyncratically, if you take out distress from high yield, it's another 50 basis points already there, to your point, around that low 200s, if you will. We think that spreads are very commensurate to the fundamentals and technicals we are going through. We could be tight and frustratingly tight for a long period of time, but we are not expensive at this point. Now, second statement right after that is, we are at the lowest amount of spread risk in our portfolios in a long time. Highest quality, highest interest rate duration.
Well, explain
and
why.
Steepeners. We don't think that volatility adjusted, you're getting paid for the spread risk that you're taking on. BBB to BB is the lowest in probably about 2 decades at this point. As a spread investor, I'm always looking for more premium. I need to get paid for that volatility that I'm taking on. So for fixed income portfolios, I can still diversified, high quality can still spit out probably 5 to 7% total return in the next 3 years analyzed. So I'm taking that probability bet higher versus going down below investment grade.
When you take a step back, you said that the technicals are very strong for credit, for bonds just in general. There's a flood of cash coming in. Where is that cash coming from? How much is coming from people who are waking up to the realization that they're not going to get Social Security or some of these other benefits when they're old and need the income, and they're going to need to really be invested and get something more reliable?
Yeah, no, I think the lock-in yield effect is very compelling at this point. I think except for the very front end, the 0 to 2, 0 to 3 year part of the curve, where I think the SOFR should adjust as the Fed comes down from the lofty levels. I think every other part of fixed income curves have already adjusted to be steeper. So the roll down, the traditional way of earning money within fixed income, and sometimes the cliched way of how we put it is the dual mandate of fixed income has high probability to be met for that long-term saver, that you have income total return, and then you have the negative correlation to risky assets, which is back as inflation is coming down.
How do you hedge against the potential for some sort of geopolitical disruption and oil prices surging? I mean, there's sort of this counterintuitive connection between bonds and oil prices that we've seen over the past few months. How much are you really planning for a scenario of that type?
I think It's tough to massively shift portfolio positioning for that one. I think the one way that we are trying to adjust portfolios is that we are overweight risk, we are overweight credit risk, not as much though over the last 3 years, if you will. So we are at the lowest point of our overweight. We still have an overweight posture that if these geopolitical tensions do flare up even further, which we had a few signs in the last 2 to 3 weeks that it could have, that we have enough potential to add below investment grade risk, which will sell off and react to these geopolitical tensions. And then the back end of the treasury curve is one more, less geopolitical, more deficit situation that we are significantly underweight.
Are you worried about the deficit?
We are nauseous about it. In terms of the biggest post-war, again, we can throw out stats all day long, but I think the way it affects is you need to grow out of it, or you need to do something, as some of the European countries are already getting onto, is be fiscally responsible and going through some tough times.
Do you actually think Washington would do something?
Very tough. I think that is one thing that they are, deficits in China is one thing, how common those two campaigns are on and how aligned they are, unfortunately, at this point.
If the deficit is one of your biggest concerns, especially surrounding the U.S. election, does it... Well, I guess what matters more for you is probably the composition of Congress. How are you thinking about that?
I think the base case, I think we are looking at the same numbers that you guys report on the terminal, et cetera, as well. Dead heat, but then, Senate and House will be split, which is actually not a bad thing for deficit. We might be looking at a Goldilocks, even treacherous Goldilocks type of scenario from
That's the least bad outcome.
20th.
The least bad outcome. Split Congress because they won't make it too much worse.
On
That's
politics.
basically it, but not fix it.
Yeah.
Vishal, it's good to see you. Appreciate it. Thank you.
Thanks for having me.
Vishal Khanduja there of Morgan Stanley Investment Management. Equities right now just about unchanged on the S&P 500. Lots of bank earnings through this morning. We've had beats across the board from Goldman, from Bank of America and from Citi. And those stocks, Bramo, doing nicely in early trading.
As you would expect them to do. A lot of people saying this was one question mark. Steve Auth saying that essentially this was one of his pillars that would make him bullish. If the banks were performing well and weren't raising any questions about the consumer, there are no questions. So for people, treacherous Goldilocks. You picked up on this. That's sort of how we feel, because it seems like every day people are saying, oh, but what about geopolitics? Oh, what about the deficit? Oh, but I'm going to buy anyway.
But what about? There's always something. Morgan Stanley, the one lone bank still to go. They report earnings tomorrow morning. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to get into some of the specifics of those big bank earnings, as you said, Bank of America, Goldman Sachs, Citi, all in the green pre-market. Bank of America faring slightly worse, just up 1.8%. They all had gains across the board. Citi's market investment banking revenue topped estimates. Both Goldman and Bank of America's Wall Street operations outperformed in the third quarter. For Goldman, it was their best quarter for equity traders since the end of 2021. All of that just pushing the bar that much higher for Morgan Stanley, which reports tomorrow pre-market. Boeing plans to raise as much as $25 billion, filing a shelf this morning, a precursor to a possible equity raise. It also announced a new $10 billion credit agreement to shore up its balance sheet with the strike still ongoing. Boeing is working to hold off potential ratings downgrades from both Moody's and the S&P, both of which have threatened to downgrade Boeing to junk status. The S&P estimates that this strike is going to cost the company more than $1 billion a month. Now, according to a press invitation from the State Council Information Office, officials from Chinese Housing Ministry, PBOC, Finance Ministry, and the National Financial Regulatory Administration will be holding a briefing at 10 a.m. Beijing time on Thursday. The focus will be on promoting the steady and healthy development of the property sector. It comes just a few days after Finance Ministry officials promised efforts to back the real estate sector over the weekend. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead and the rest of this week. Live from New York City, this is Bloomberg. .38 minutes away from the opening bell. Equity futures totally unchanged, have been all morning. After posting another all-time high in yesterday's session on the S&P 500, the standout move cross-asset has been crude. We're down by more than 4%, WTI 70.74, a break of 70 earlier on in the session following a Washington Post report that maybe the Prime Minister in Israel, Benjamin Netanyahu, might spare energy assets in Iran.
Now, Stephen Cook poured a little bit of cold water on this, basically saying he thinks Israel will do what Israel wants to do. But look what happened on the weekend. The Israelis are about to get a THAAD. This is a serious piece of equipment. There's only 7 that the United States actually has, and they're giving one to Israel. This is the first time ever that this is happening. When you have that piece of equipment, maybe you're going to listen to the administration.
Brent crude 74.38, WTI 70.69. Down across the board by something like 4%. As we count you down to the opening bell, let's get to the trading diary. The rest of the week, the calendar, the schedule looks a little something like this. Do not miss this one. Lisa sitting down with San Francisco Fed President Mary Daly later on. Tomorrow, more earnings from Morgan Stanley. Thursday, we'll get an ECB rate decision plus retail sales and another round of jobless claims and more results from Netflix and TSMC on Friday. Housing starts and building permits. Bramo, the floor is yours. Mary Daly coming up a little bit later.
I'm really looking forward to speaking with her because she tends to be very thoughtful based on the conversations she has as she tours her entire region, and she calls it qualitative data. It's not anecdotes. It's trying to have set qualitative understandings of how people are feeling. I want to know what the destination is. I want to understand what neutral is and what the goal is of the Federal Reserve, which does have a dual mandate of both inflation and employment. Longer term, what is the healthiest balance for an economy? And to really get into that, because right now, that seems to be an area that this market is struggling with, given how much bonds have been fluctuating all over the place.
Apart from trying to find out if they were bullied into voting for 50 basis point rate reductions at the last FOMC meeting by the chairman, I'm sure that might not come up. Let's park that. I want to talk about financial conditions. If you speak to the CEOs of asset managers from the CEOs of banks, they seem to have a very different opinion on the level of interest rates that's required right now because financial conditions are so easy. We just had a conversation about how tight credit spreads are. We've talked repeatedly about equity markets at all-time highs. How do they think about that piece of the puzzle?
Especially because financial conditions for big companies, the most creditworthy borrowers, are very different than the financial conditions for particularly lower income and middle class individuals and families. That has been restrictive, and you have seen that start to soften. But how do you dovetail those two when you want to both cater to a certain cohort that's definitely struggling while also not creating frothy conditions in a market that is much more immune to rate increases and decreases? And that's a real struggle that I'd love to hear her thoughts on.
We are 3 weeks from the election. Do you think she's going to dive into you with what 2025 might mean if the Fed is actually starting to think about it? Is she an oy the deficit person, or does she care?
I would guess that probably she has her eye on it, but most of them are trying to steer away from that, looking at what the parameters are of current conditions and extrapolating that out.
I imagine you're planning to read an Adam Posen quote to her about 2025 and the prospect of raising interest rates.
Is this possible? Yeah, and she probably will say anything is possible. We deal with the conditions as we see them. I'm just telegraphing what I expect to be.
Look out for that conversation with Lisa and Mary Daly, the San Francisco President, a little bit later. San Francisco Fed President. Get my words out. Coming up tomorrow, Julian Emanuel of Evercore ISI, Keith Lerner of Truist, Charles Myers of Signum Global Advisors, and we'll catch up with Howard Lutnick of Cantor Fitzgerald. Looking ahead to all of that as we count you down to the opening bell. Equity futures on the S&P just about positive from New York. This is Bloomberg.